My name's Lynn Gillette. I'm the president of the Silicon Valley chapter of AAII, and this is our September 12th program featuring Kristina Kuprina. I hope I said that right. And the subject of the first presentation will be economy and the election. Our presenter is president and founder of the Sequoia Wealth Advisor. She attended the University of San Francisco, State University in San Francisco, and the Haas School of Business at UC Berkeley. Was named to the Forbes Top 1,000 Female Advisors. She's had, her firm was formed in 2007, and she has extensive experience in the economy and a whole bunch of certifications, and holds Series 7, 66, 31, and 24. She has as I mentioned, any of you who were listening earlier, some very good educational videos on her website, which I encourage people to visit, and which does something that I've always really liked. Is I like people that are advisors and educate at the same time. Makes informed investors, whether they do it themselves or use advisors, are usually much more successful. So this should be an interesting presentation. So Kristina, you have the floor, and looking forward to your presentation.
Thank you very much, Lynn, and thank you, everyone. I'm an economist by training. I've been doing this over 30 years now. I'm in my 50s. That time went really fast, that's for sure. And I really, really love the economy and economics. It's a great passion of mine. And during these times, I've been doing lots and lots of talks by Zoom and by video conferencing. Previous to that, I would travel around the country and talk about the economy, which is fun. And I get to meet a lot of people and get a lot of different viewpoints and ideas and opinions. So today I'm going to go over and touch upon some high-level things around the economy, currently where it is, as well as the elections and some points to consider there. I strongly encourage, please, questions and answers. And I know that's going to be asked of me, because I'd love to customize this specifically for the audience and what is most valuable to you, so that I don't sit here just like a talking head talking about things around the economy. So I'll start with kind of a high level with the economy and what's going on. The question I get asked the most often is, why is the stock market doing so well? We're in the midst of a pandemic, social unrest, all the political divisiveness, everything going on. Why is the market's doing so well? And I'll talk about that first. Believe it or not, and I'm looking at, yesterday's data, consumer spending as of this week is at 95.7% of where it was before the pandemic hit. So just let that sink in for a moment. With everything, with all the shutdowns, with all of the disruptions, we're almost 96% of where we were. We're still spending, we're just spending differently. And that is a big part of it. Now, of course, a big part of that extra spending is the fact that the government stimulus and the Federal Reserve's policies, which I'll touch very briefly upon, because a lot of you probably know, and I'll, of course, be open to questions about that. So when the pandemic took hold and the government had shut everything down, we were in unprecedented territory on the economic front. The Federal Reserve rushed in and took some extraordinary measures. As a lifelong economist, I'm still stunned with the tactical accuracy of the decisions that they made and how they did it to support the system in a time, and again, which not only the United States, but many other countries were shutting down as well. And that helped put a support in. And closely behind that, also the federal government, Congress, that came together with various stimulus programs, the biggest one being the big 2.2, I guess it ended up being, $1 trillion CARES Act. That also got money into the system. So much of what has promoted the or stabilized the economy and promoted the market's growth has been government and Federal Reserve intervention. Without that, we would be in a very, very different place right now. Now, that's waning. As I'm sure everyone knows on this call, they have not come to an agreement on the most recent stimulus. I'll talk a little bit about that in a moment. It so far has not significantly slowed things down. The unemployment, the additional unemployment that went away at the end of August end of July has not significantly slowed down the economy yet. In fact, people unemployed are still spending more than they did pre-pandemic. Okay, this is this week's data, still spending more. I can give the exact number of what that is. Might take me a little bit too long to dig it up. But they are still spending more. Now that will not continue, and we don't know if they're spending more by going into debt or if they're spending more because they have opportunities, or they still have money that's been saved. It will be very important for additional stimulus, but the stimulus should be very well targeted because the expenses related to the shutdown and the pandemic are going to be going on for years. It's not a short-term fix. So again, I'll talk a little bit about that, the stimulus in a moment. I get more to the political side. Overall, the strength of the economy is a lot stronger from economic data, driven by economic data, than what you may hear on the news. Now, I'm not a Pollyanna-ish person. I'm practical, I'm an economist, right? There are a lot of risks and there are a lot of concerns and there are things that are going to bubble to the surface in the future. So the positive side, again, spending is up. People are just spending differently. When I talk later about innovation, I'll talk more about the fact that the technology has done an incredible thing with increasing productivity and efficiencies and allowing money to less money to do more to drive economic growth. That has been another thing with this use of technology. Imagine if the government shutdown, the pandemic had happened 20 years ago. Imagine that. We would not have had the resources that we have now through technology to have groceries delivered, right? To have things like Amazon, things like Netflix, things like how we're communicating right now because we're not all supposed to be in a room together, right? If this had happened before, the effects of the economy would have been far greater. Forward-looking companies that were ahead of this are benefiting now, and you can see that by their stock prices. So that has, again, been a big help to it. Now, the biggest concerns, though, I want to bring up now the concerns before I switch into a little bit on the political side and then go to the Q&As. The biggest concerns here is that there are things that are sort of being suppressed right now and sort of being delayed. The biggest one of all is commercial real estate. Not all commercial real estate by any means, but certain areas of commercial real estate, especially those carrying high debt levels and are not going to be able to collect rent in the ways they expected. It is unlikely, regardless of who's in the White House or in Congress, that we're going to be bailing these companies out. So this is going to start to bubble up in the surface in the future. The other one is some areas of the economy have come back very quickly. Other areas are still sort of struggling along, sectors and areas, and others may take a long time to recover, get back to where they were. Travel and leisure, conference services, full-on sporting events and concerts and things like that will take some time. Regardless of how quickly we get a vaccine, it will take a while to vaccinate 340 million people or whatever our current population is, right? So these things will take longer, and the people employed in these sectors will either need to find other career options, or it will take a long time to get unemployment. So unemployment numbers are recovering at a pretty good clip, okay? Or more people are becoming employed at a pretty good clip considering where we are. But it will take a long time, and I'm saying probably end of 2022, maybe even 2023 before we start to see numbers like we did before the pandemic. So higher unemployment rate for a period of time, concerns in the commercial real estate sector. There are some other sectors as well. Within companies, the biggest thing is there's not really, if you're a stall box investor, you may want to rethink that. You really want to rethink that, because the shift that's taking place within companies right now are those that are quickly adapting to technology and quickly adapting to the disruptions in the supply chain and different ways of doing things are going to come out ahead. Regardless, they don't have to be a tech company. I have a big portfolio of companies that are traditional companies, but they're figuring this out. They're figuring it out quickly, and they're going to crush their competition over the next couple of years as the economy continues to grow. It's not a style box. It's who is quickly adapting to technology. We got thrust 6 years in the future in 6 months to the use of technology. And some companies are going to catch up and some are not going to make it. And it's a really big deal. So that's something to watch closely, is the adaptation that the companies that you're investing in. Look very closely at how they're adapting to the changes, because this is going to transcend COVID. This is a long-term thing. It just got, again, we just got pushed into the future. So that's okay. Other considerations or concerns to watch very closely for the cities and states. Okay, many of them were not in good shape before the pandemic. Okay, I'll give you some examples. New York, New Jersey, the state of Illinois, they were in serious trouble beforehand. The public pensions, Okay, they're vastly underfunded across a wide swath of the United States. This has been a problem pre-pandemic, right? It's just gotten worse. And those cities and states and their debt are going to be something to watch very, very, very closely in the future. Some areas that people may consider conservative may have a greater risk. Again, it's not all the debt. You have to look at how is that debt supported? What is the source of funding? What is the protection for the bondholders? Will be very important things to see. And that's a big challenge that you're seeing in Washington right now. The big argument in the current stimulus, actually, before I get into that, because I don't think many, if any of you know me, I am nonpartisan. My presentations are nonpartisan. I take no side or no position on politics. I'm speaking purely as an economist. I'm well aware of the fact that sometimes just saying things as they are, people can take it in different ways, but that is not my intention. So I'm more than happy to get your feedback on the questions. But recently, the Democrats and Republicans negotiating the current round of stimulus were actually agreed on some very important things. They agreed on unemployment to extend the increased unemployment. They agreed on a number of areas, like not restarting, but reopening the PPP program. The PPP program, which was for businesses to be able to get money, primarily if they use it for payroll, rent, and other things, it was even forgivable. That program is not run out. There's billions and billions of dollars left in it, but the access to it has run out because it's been shut off, and it can't be reopened without agreements. So there's areas that the White House, Senate, and the House, Democrats and Republicans agree on, and they were trying to get that through. It did not happen because they, I don't know if I'm using the proper terminology, the Democrats or the House wanted to also add funding for cities and states and a lot of other programs, climate change and the like, that were a bit outside of the scope. I'm not going to get into whether this was a right or wrong thing from a political or a social aspect. I will say from an economic aspect, that was unfortunately probably not a wise move from the standpoint is it puts a lot of people in a big pinch. There's a lot of people out there that want to get work and can't work because their skill set doesn't match the jobs available. Currently, there are more jobs available than there are unemployed people. On the most recent unemployment report, there are the jobs, but there's a mismatch in skills. There's a mismatch in geographic regions. And that's a big concern going forward. I bring this up because 2/3 of our economy is consumers spending money. The more money in consumers' hands in the time in which there's significant limitations by the government shutdown, also by people's fears and concerns around COVID and going out and doing activities, that it is going to require some degree of stimulus, but the stimulus should be carefully targeted because we do have a limit to how much money we can spend as a nation. Throwing trillion here, trillion there, that starts to add up pretty quickly, and we are going to have some significant issues, not probably in the next couple of years, but not in the too distant future. And that's assuming that we don't get into all the other spending programs that are being talked about. So I want to talk then a little bit about the economic policies or specific policies that have an impact on the economy, or for your members around maybe financial planning or personal planning decisions that are coming up in the election. Okay, so first, again, on the high level, the markets will adapt to either one of the candidates being the president. That's what everybody talks about. Oh, if this person gets elected, this person gets elected. The markets will adapt to it. It's not as much the election of either the re-election of Donald Trump or the election of Joe Biden that will have an impact. It's so much more their policies, what they actually do. So I'll spend a little bit more time talking about Joe Biden's policies than Donald Trump's, because Donald Trump is the incumbent and we pretty much know, well, as best as we can know anything with Donald Trump. Whether you like him or hate him, he's not necessarily predictable. But what the policies are that he's focusing on, lowering taxes, his infrastructure program and the like, I think is pretty widely known. Also, for any of you that want to go deeper, just go directly to the candidates' websites. They have a lot of their information there that can go a little bit deeper into this. The markets will not care as much for investing, believe it or not, and again, this is purely speaking an economist here. Traditionally, the markets do the worst when one party controls the House, the Senate, and the presidency. Doesn't matter whether it's a Democrat or Republican. Why is that? Traditionally, because that creates more uncertainty. There's no negotiations. Things can get pushed through. A lot can get pushed through quickly, which can really disrupt companies' balance sheets, companies' financial planning. things on a big nature. So anytime there's so if the Democrats take the White House, the Senate, and the House, so Congress, they take the majority, that will probably disrupt the markets the most. I'm not going to say the same thing about the Republicans because the probability is something like 5% that they would take the House. But if that happens, again, the same thing, kind of that disruption. It matters a lot more, actually, if Joe Biden is elected. It matters a lot more who he uses for his cabinet, who he elects for Treasury Secretary. There's a lot of talks about that being Elizabeth Warren. Again, I'm speaking purely on the economic front. That will be something that will probably be very disruptive to the markets because of a lot of her stances and policies. So these are probably what, again, in short term. Another thing I'll talk about before I jump into the policies of the contender, Joe Biden, or economic policies, is a contested election. There's a pretty high probability at this point that the election results will not be known to us on the 3rd of November. Both parties are setting up, very overtly setting up to contest the election, both at this point. The Republican side around the potential for fraud with the mail, sorry, I'm not using the right terms here, the ballots being mailed out without being requested or asked for, and the fact that there could be fraud. The Democrats on the mail not being processed properly and not all the votes being counted properly. It's probably a lot more to it than this. Plenty of sources to get that information, but each side has already kind of indicated that the vote may be contested, especially if it's close. So we could see a situation like we saw back in 2000. Remember the hanging Chad and Bush and Gore? And it went to the Supreme Court, and then it was decided, and then we went on, I think it was sometime in December. The markets didn't care for that very much at all. And so I think that we could get a bit of volatility around that, a contested election. Ultimately, there's a process. It will get decided. It just may take a little while. And if it gets figured out by January, it's probably going to be fine in the end, but it will be a lot of noise around that, most certainly. So I'm going to talk a little bit more again about kind of the policies that Joe Biden is saying that he would like to do if he gets into office. I'm not going to spend a lot of time on this. Again, I would encourage people to go to the website. I also would strongly encourage, I would also like to bring up again, people vote for many other reasons than economic policy. So in no way should this be construed as me supporting or detracting against either of the candidates. The biggest ones I think that would be things to watch for, again, your individual investors is the increase in the taxation of capital gains and dividends. Okay, so that depending on your income level, currently it's the 20%. Over one income level and 15% on another one. The income level is 441,000. That would potentially go to all dividends and capital gains taxed at ordinary rates. So just like short-term gains. Something to watch for, especially for your higher earners. The other one is the federal estate and gift tax exemptions. That could be reduced as well. Okay, so currently we're over 11 million, so most families will qualify for a gift estate tax, but that's another thing to look at. The biggest two that I want to bring up here, and again, I'm going really quick because this is highly individualized and I want people to talk to their financial planners. They can talk to me if they have questions. I can get them the exact information for their situation. No, you don't have to hire me. I'll just point you in the right direction. But to go into this deeper, a big thing right now with a lot of people's planning is factoring around the step up in basis. So you probably know when property is inherited, the basis of that property is stepped up to the value on date of death. That would go away. So that the property would be taxable. There's two different programs. One is it goes away completely. The other one, it goes away after $400,000, which in the state of California, that pretty much means the house, right? a portion of the house. So the step up in basis, the reduction or elimination of charitable giving deduction is another one. For the real estate people, if you have any real estate investors here, potential loss of the 1031 exchange or significant limitations to your ability to do that. In other words, again, a cap around 400,000. So these are planning, considerations with this, just for an awareness purpose, to be aware that that can have an impact. All of these things, I don't want to say all, most of this can be mitigated by proper planning. So the idea is my intention here is to bring the awareness. If this happens, plan accordingly. Update your estate plans, work with your attorneys, your financial planners, and take a look at that. So that was kind of the around the election, the considerations there. Ultimately, like I said, it will not economically make a big difference in the short term. The longer term, it's policies. And I would like to give an example about that. Obama ran on, he was going to repeal all of Bush's tax cuts. Okay. When Obama got elected, he got elected the first time in the midst of the Great Recession. He did not do that until 2012. He was wise enough to see that the last thing you want to do is significantly raise taxes during the midst of an economic recession. At this time, we're tracking on GDP Now, which all of you can look at, is using all the same data we use. At GDP Now, we're tracking at somewhere in the neighborhood of 25% GDP increase up for this quarter. So basically, we had the worst and shortest recession in U.S. history. By technically the first quarter, because we were slightly negative, was 1 quarter. Second quarter, obviously significantly negative. Third quarter, things are recovering pretty quickly. We'll get those numbers, the first draft of those numbers released officially at the end of October. But right now, again, we're tracking about that rate. So even though it's not maybe officially going to be a recession, when the new president comes in place, they're unlikely to do anything that will disrupt the economy, just, I would imagine, out of a wisdom, unless there's a lot of political pressure, or again, they take the House, the Senate, the presidency, then there's a lot of power. They usually, traditionally, will not keep it beyond the first 2 years. So they tend to want to get everything pushed through. An example, again, I'll go back to Obama. When Obama was elected in 2008, he had a majority or mandate, I guess is the proper word. And that's what got Obamacare started, because it was this like opportunity to get it done. It was harder for people to contest it. So again, let me stop here because I want to see if there's any questions. There's so much stuff I can talk about, and I want to be sure it's relevant to the audience.
Hi, Kristina. So just focusing on the national levels first, a lot of people are saying that unemployment rates may not return back to, what we had until 2023. What are your thoughts about unemployment and whether, we're going to get that quick bounce or not?
Well, yeah, I agree with that. I do think 2023 is what I'm seeing too. And I pay a lot of money for my data, so the accuracy is pretty good. I would say that's the case too. But remember, we were at 3.1%. We were at like historically ridiculously crazy low numbers pre-pandemic. So for it to take that while to come up very quickly in the beginning and then come up more slowly. Part of that is the big unknown is what happens around COVID. So that's the biggest mystery. Do we find a really good viable treatment and or a vaccine, or does the virus just peter out on its own? Not saying what will happen. I'll leave that for the experts. The experts don't even agree. So the last thing I'm going to do is throw my opinion in there. But if something happens around COVID that could speed things up, because then we would be inside opened up and comfortable going to large sporting events, conferences, and things like that. That would speed up and get us there faster. And reverse of slowing us down is that one thing to keep is that I use this example as a great example because of all the forest fires happening. And I have some clients that are firefighters and have been on the front lines during this time. And they say one of the biggest dangers, and there's a lot of dangers in fighting a forest fire, but one is that many of the areas have not been maintained. The forest floors are very thick with duff. Duff is the word they use, which is layers upon layers, and they're supposed to be kind of swept or cleaned off or on occasion, right? And when that duff piles up, what they don't see is the fire burning below the duff until it ignites somewhere else and it comes behind their lines and whatnot, right? That's the danger. So I'm going to use that example of the fire going through the duff and popping up and then capturing people by surprise is what will happen with a lot of the, results of COVID. Is a lot of jobs are not coming back. A lot of things are going to be done differently. When companies figure out how to do things differently, they don't necessarily go back to the way they did it before. People also may be less comfortable doing things. So if we have a job retraining focus for jobs that may not come back as we have in the past, that may speed things up. Because as I said, right now there are more jobs available than there are unemployed people, but there's a huge skill and geographic area mismatch. So if that can be resolved through some type of retraining and whatnot, that would be it. So that's what I want to add, is that to get back to 3.1 will take a long time, but to get back to 6 or 5, which is historically good, will probably happen sooner. And how that happens and what forms of support are in place is another one. And I'm going to give a last example on that. A lot of younger people right now, they're now deemed unemployed. College age kids deemed unemployed. They're in unemployment rolls because they lost their job at the restaurant or at the coffee shop. And a lot of them are doing what I would call, maybe is not right word, gig economy, of helping parents with teaching their kids, tutoring the kids around the homeschooling. So not every parent is prepared to homeschool their kids. It's a big, big challenge I see a lot of my clients facing. But there's a whole industry right now of college age kids that are going out and helping with the pods and the homeschooling and the home learning. Those are still unemployed, but they're making an income doing so. So let me stop there. Hopefully that's hopefully that's an answer.
Yes, that's great. Could we also maybe focus a little bit more on California's economic outlook, in particular our current state finances, and whether that's going to affect the prospects of California municipal bonds?
Yes. At this point, California municipal bonds, now remember, there's a lot of different kinds of municipal bonds. There are high yield, higher risk bonds, bonds attached to things that the revenue is not secured. And those bonds are at risk, most definitely. You need to know what you own. I see with investors a lot is they buy a bond fund and they really don't know what's in it. They're buying it for the yield, or they're buying it because it has a low expense ratio, or they're buying it because that's what's available, tax, or they're looking, oh, Cal, okay, good, no taxes. But you need to know what you own, because there's a lot of bombs in there. There's a lot of bombs in there, especially with the more passive funds. And there will be some that are likely to default, especially in the higher yield, lower credit rating space. California is better off than most states. And because of the fact that we have a lot more revenue coming in from the government has a lot more revenue coming in for a lot more different sources than states that are more single focused. So I'm going to contrast a minute for California with New York before I jump into California more. So New York, their wealth is more concentrated in the financial and the advertising industry. And what happened is New York decided that they wanted more revenue to support the social programs and whatnot. And this was a couple years back, well before COVID. So they raised taxes significantly in New York on the wealthiest, right? They raised their state taxes. Well, the problem with that is most wealthy people in New York own houses in Florida, right? And they are a lot more mobile in finance and advertising than other industries would be. And they had a huge outflow of people. It was so significant that they were even trying to pass a law that they could claw back your income. They could tax you 6 years after you left the state. Clearly that didn't fly, but they tried. That all of a sudden New York went from a surplus, huge deficit in the billions of dollars in state tax revenue. The state is really struggling. And again, was struggling pre-COVID. They're in far worse shape now because it just drove people out. They crossed a line and it drove people out. California, on the other hand, just recently there were 2 assembly bills that were going to significantly increase taxes on higher earners in the state of California. And Gavin Newsom came out on record saying, I'm not supporting that. We're in a mobile economy and we're not chasing people out of the state any more than they are. I will tell you, as a planner, most of my clients are based in Silicon Valley. A lot of people are looking to leave the state. They're really seriously looking to leave the state because they just figured out how mobile they are. And there's you can buy a lot more house if you don't have to spend as much in taxes. And we're right next door to this state called Nevada with 0 state tax. And if I want to predict a state that's going to grow and do very well in the not too distant future, it's going to be probably Nevada if they continue on with that tax policy. Why? You can live in the Reno, Carson City, Minden-Gardnerville area. You can get to the airport in 30 to 40 minutes, depending where you are, and fly to San Jose in 40 minutes on a Southwest flight, right? You can commute, quote unquote, commute to the Bay Area and work remotely in a much cheaper state. So I bring this up is that California is, I'm sure, well aware of what happened in New York and doesn't want to push it too far. But there are risks here because we have a very high percentage of our population on public benefits in California. A very high, I think it's around 40-ish% on public benefits. So we have a very high cost to carry a very large population, and that requires bringing in more revenue, and that will be a challenge. So California is challenged. All of the fires won't help either, because that also can drive people out, not because the fires drove people out, but if your house burns to the ground, do you rebuild here or do you go somewhere else? That's a time to think about that. Not having the power be predictably on, all these little other things can eventually kind of make people rethink where they're living at a time when they, again, just figured out how mobile they really are. So I think watch California down the road to see how many people really leave and how many people end up staying as the COVID situation unwinds, would be my suggestion. But if you own California debt, I think it's really important to understand, if you're as individual investors, make sure you just understand what you own. And if you have it in a mutual fund, make sure they're really reviewing what it is that they own and the objective of the fund. If the objective of the fund is to get you as much tax-free income as possible, you're carrying some pretty good risk in there. Is it right? Is it wrong? That's you as the investor have to decide that.
Would that, I guess, apply to just general California, like money markets as well? Or,
It depends
or is it just bonds? Sorry, go ahead.
No, it depends on what's in it. See, even with money market, what's in it? What's in it? You have to look at the quality of it and what's in it. Is right. There's less risk, of course. There's less yield. There's less risk in general. My experience is, and I don't want to pick on any investment company here, but there are some investment companies that focus on doing things very cheaply, kind of like the Walmart of investing, and they don't manage it as actively and pay as a close, because credit quality can deteriorate very, very quickly. It just takes one change and bam, you go from here to here. And the rating agencies are not keeping up with this, right? They can't possibly. We saw that in 2008. So the rating agencies can't catch up with the fact that this highly rated bond here, all of a sudden it's not getting revenue because of a policy change or a COVID shutdown. And so you can't always see that this AAA is now a triple B and getting close to dropping below that. You can't always see that right away. So passively managed low cost tends not to actively manage as much as either a professionally hired bond manager or a more active, but this is a generalization and that is not always the case. So it's important to just understand the fund, whether it's a money market or whether it's, again, managed by like a mutual fund or something like that. Even in the ETF space, there are some far better quality ETFs with municipal or other types of fixed income securities. And there's some that are like train wrecks. It's just like, this is going to go bad really quickly. Same in the preferred space. It's knowing what you own. I can't stress that one enough. And like I said, understand the risk of it and decide if that risk is appropriate for you. Because there's no right or wrong to it. I never want to say, oh, this is too risky, don't own it. Because you may be accepting the fact. The thing with bonds is when bonds default, you get pennies on the dollar. Your loss is permanent. When stocks go down, often they recover. Most of the time they recover, given them the right amount of time. Bonds is a different story. That there's more risk in bonds than there is in stocks generally, all things considered. So again, I don't want to speak, like, oh my gosh, sell them all, or it's all dangerous, or get rid of that cheap passive fund that you have. No, not by any means. Just understand it. So.
Got it. Thank you. And then can maybe we clarify a little bit about the tax bills that you mentioned. I know, as you mentioned, the Assembly was considering raising the upper tier for state taxes, and then also potentially putting in, I forgot if it was like a, similar, like a 10-year kind of, even after you leave California, you would, be on deck for any revenues that you made from California.
Yeah.
So when you mentioned that Newsom, said he would not support it, do you get the sense that it's a temporary reprieve where, we're saying, hey, let's postpone this discussion until, say, 2022? Or do you think this is something that, is kind of just dead on arrival?
I think it's going to depend on the thing that the states are waiting for is the big reason the Democrats are pushing so hard not to negotiate on the unemployment package and additional stimulus and PPP, the things that everybody agrees on. The reason they're adding this other stuff in is primarily because the relationships the states have. The states need the money. They're planning on it. None of the states really cut back on spending, and the states are hoarding, for the most part, what they've gotten from the CARES Act. And there's this idea that they're going to get more stimulus, there's going to get more stimulus, and they're going to get more stimulus. And the Democrats are holding hard on that. That's probably the biggest of the negotiating points, right? So if the states don't get the money from the federal government, or get a lot less than they were hoping for, they're asking for $910 billion, I think was the number. Now, and that was an ask. I'm sure, it's going to get whittled down quite a bit from there. But even the government, even the federal and their own party says they need half that. Okay, I can't think of the rating agencies. Moody's and S&P say the cities and the states need about $500 to $600 billion to get out of their hole, like out of this whole thing, right? So that's a lot of money, right? That's a lot of money, but the ask is very high. And the reason the ask is very high, the cities and the states are really holding out for that. They're really kind of expecting they're going to get it. So if that doesn't happen for any reason, okay, let's just make up this scenario. Donald Trump wins the presidency. The Republicans keep the Senate. There's not been a major change, and they have enough control that this doesn't get through. I do think you're going to have them coming back and saying, we need more revenue. We need more revenue. We need more revenue, because it's not going to happen the way that they expected. There's a lot of expectation that this money is getting through, whether it gets through in current negotiations or it gets through because the Democrats win enough control in Washington to be able to push it through. But I do agree. I do think it will come back again. But I also can't imagine that Newsom's not well aware of what is happening in the state of New York. I mean, again, he's got to know more than I do. And he's saying, okay, at what point do we drive people out? What point do we actually drive people out? If you drive out the people that have the money, how do you support all the rest of the programs if things can get bad pretty quickly? So there's a balance. There's a balance in there, trying to get more revenue to support the state, but also not that tipping point where people say, we're done. That's just too much for us. And in California, it's a challenging place, because if you're a business, you can't just move out of state. If the bulk of your income is coming from California, you're still going to get taxed on it. If you're an individual and the bulk of your income is coming from California, you're going to get taxed. So California has big claws, really, really big claws. They will find you wherever you are. And, and again, they'll also make sure you actually really are not a resident of California. The California Tax Board is really diligent on trying to find that money when people look to relocate to other states. So yeah, around COVID, it's really interesting. If you look at an excellent chart that I have that shows, the case rates per region, the 4 regions in the United States, right? So West, Midwest, Southeast, Northeast. And you saw like the Northeast, like New York area, had this huge spike, and then they dropped down, and they haven't had the big outbreaks since then. And then other states had later spikes, right? And now they started to drop back. And like you see the spikes in the regionally, and they all seem to go through the same process. Whether they started slow, they had a spike later, then they declined, or they started early and then they stayed declined since then. So just assuming that this continues on with California put in another tier system, purple, red, yellow, whatnot, and they're trying to follow that as their process for it. I'm not going to say whether it's a good process or a bad process, because I'm not remotely qualified to really opine on that. It does give, though, some degree of clarity, because this was a problem for so many businesses. Is you're a restaurant. Now you think you're going to reopen. Yay, we're going to get to reopen. You order a bunch of food. Oh, no, sorry, we have to close. More cases. How do you run a business like that? Oh, I'm bringing all my workforce back. We're ready to open. Oh, we got closed 2 days. And that's what happened in Santa Clara County. Here in Santa Cruz County has been, I think, more open. We haven't had as many cases over here, but over there it's been a mess for businesses, which that's harmful to the economy. Because you can't open, close, open, close, open, close. It doesn't work that way. You have to hire workers, you have to get supplies, et cetera, et cetera. So that was actually probably the most disruptive. With some form of the system, still there's uncertainty, because of course they can rescind the opening if case rates increase or whatever the metrics are increases. That's going to be challenging. Again, as an economist, everyone's doing this a little differently, and no one has a system that's really worked well. When I say everyone, different states, different cities, different countries are doing things differently. Countries and states and cities around the world that had a great start, had an outbreak later. Ones that had outbreaks early seemed to get under control, but there's not really been a correlation to what they're doing to the case rates. There hasn't been. Like if you just look at raw data, there hasn't been. And that, I think, economically is going to be challenging for companies. Where you run into that risk, what we saw kind of more early on, is that you'd have states that would open next door to states that would close. A good example was, I think, South Carolina and Georgia. And I might get this backwards, but I think Georgia opened and South Carolina was closed. And people close on the border between South Carolina and Georgia just went across the border. You can track this. You can track people's movements now with technology. There was this huge flow of people leaving South Carolina to go to Georgia to get stuff done, probably their hair, shopping, go to restaurants, whatever they wanted to do. So what does that do to the revenues of South Carolina? The money's flowing over there. People are talking with their feet. People are traveling. People are doing things. The TSA daily numbers of flights out, we've crossed 1 million. Okay, now we used to be over 2 million a day. We're halfway there, right? But we were down to 87,000 people flying a day in the height of the pandemic. People are making choices themselves, and they're going out and spending, and they're going to go where they can do it. And so states don't want to be that one state that's locked down when everybody's opening around them. It's that balance, right? The pressure on the politicians is immense because you have one side that says, shut it all down until there's a vaccine or a cure. And you have another side that's saying, open it all up, you're killing the economy, you're destroying my business. There's not an easy answer for it. But economically, I gave you that number earlier, the percentage of people, the consumer spending numbers. People are spending money, they're just spending it differently. But how does it help your state's revenue if you shut down all your restaurants? You shut down all your groceries, I'm sorry, not your restaurant. You shut down all your stores and your malls, and people just go buy on Amazon, right? What is that doing for your workforce, local workforce? What is that doing for your small businesses? What is that doing for communities? A big area that's being hit right now, college towns. Think of the college towns, right? Traditionally, all the kids move in, they're spending money and drinking beer, doing all their stuff. The college towns, it's booming for all these businesses. Look at the ghost town now. The college towns are greatly suffering. Not only are they suffering economically, but it's census time. What do you think that's doing to their census numbers? Right? It's a big, big deal about how people are doing things differently. And this is when I talked about the fire burning below the duff. The impacts on these college towns. You want to talk about places you want to watch your bonds closely? Probably college towns. Right? Because there's going to be impacts because that revenue is not there. How long does schools stay shut down? Nobody knows, right? Nobody knows. Also, educational institutions. We're going to talk about risk there. It's going to be hard for colleges to continue to demand very high tuitions if they aren't like the top of the Ivy Leagues going forward. So a lot of parents pay, again, as a planner, parents pay, they want their kids to have that college experience. It's not just the education. You can get that online. The college experience of all of the things that any of you that have kids know about. It's kind of hard to be dropping, 30, 50 or more a semester for your kid to sit at home and watch videos, right? That's gonna change. So bonds tied around college towns, again, colleges. So again, fire burning below the duff. I can give you a long list of stuff that's probably gonna pop up over time. The fires, I think one of the big issues that I talk about a lot, because even if you're just a cold-hearted capitalist, this is an issue for you. You don't have to care about social programs at all. Even if the income inequality in this nation is going to create huge problems in the future, and we will have to find solutions for it sooner rather than later. But what's going to happen with these fires? Here in the Santa Cruz Mountains, a lot of people lost their homes, and that's just one of many fires that are taking place across the western United States. Many of these people, even if they can afford to rebuild, can't afford the insurance. What do you think the insurance cost is going to be for anyone with it anywhere near a tree right now? Anywhere near a tree, who can afford the insurance? So you will drive out anyone that doesn't have enough wealth and income to A, build a house in the forest of whatever the new building code requirements are going to be, I don't know, out of cement or something, and B, be able to afford the insurance. So you're going to drive a lot of people out of the area that can no longer afford to live here, and you're going to do this across the western United States. So that's going to be a big issue. Where do these people live? How do they live? How do they rebuild? That's going to be, again, a financial challenge as well. You can see the results of that. You can see what happened, the dispersion of people after the Paradise Fire. We had a lot of people up there, generally lower income people, and where they had to live and how they had to move, and who could rebuild and who couldn't. There's kind of an example of that. But that, as you said, look how many fires are happening around the Western United States. A week ago, I think, we'd already burned more acres in California than we had in any other fire season. We have 2 months to go. So I would say to people, regardless of your viewpoint on global warming, let's all agree that the weather is costing us tremendous amounts of money, and it's going to keep happening. keep happening. And the costs are huge. So that's a big issue. The debt is a big issue for this country going forward, but the cost of all this weather around the nation is going to get greater and greater. Again, regardless of your views on the climate, it's just we got a lot more people, and it costs a lot more to rebuild their houses and businesses and the likes.
You mentioned the statistic around people traveling more. Can you address that a little bit more? It sounded like you said 2 million travelers, right, in the U.S. during the high times, and now we're back to about 1 million travelers.
Well, these are TSA numbers. So the TSA, how many people go through the TSA on a daily basis in the United States? So it's not all travel. It's not people traveling by car, which is by far more popular right now. Many people's summer vacation was driving somewhere into nature or renting an RV and going into nature because that's very COVID friendly, or I guess COVID protection friendly. But just from airlines. So it's an interesting number because you want to track the movement of people and their spending habits. There's tremendous piles of data. Again, costs a lot, but you're able to get it. And this is all anonymous. You don't know who these people are or what they're doing or any details, but you can just see it. So the TSA data in April, in the height of this whole thing, about 87,000 people a day were still flying. And that's I'm seriously surprised there's 87,000 people a day flying. People had to fly for whatever reason. They had to fly. On an average day, pre-COVID, about just over 2 million people a day flew on average day. Obviously, it varied time of year and whatnot for all different reasons. Now we're getting close again. It varies every day, but we're getting close back up to the million again. I don't know why they're doing it though. My assumption is there's probably a lot less of flying for business because we have this access to things like this technology, and it's people flying for other reasons. But we are getting back up to almost the halfway point at this point. And that's very interesting given the fact that much of the rest of the world is shut down. I go to Peru twice a year. It's a big part of, kind of my spiritual path, and I do volunteer work down there and whatnot. And I went in January. Obviously, I wasn't able to go in July not because I didn't want to. I would have gone. I'm fine with it. But Peru shut down because of COVID, right? So you think that even people who want to travel to a lot of the world can't. And we still have that level of traveling. But in the early parts of this economic data, and how I knew and how I was advising people, if you look back at the old videos, that to invest, that we're going to recover and faster than people expect, was because you can see this data in real time. You can see people moving around. You can see that people are willing to do things. A lot more people are willing to do things than the government will allow them to do. Okay, and I'm saying this for an example of if people want to get their hair cut or a massage or go to a restaurant, go to a bar, they're willing to travel to do that. Not everyone, and not everybody's comfortable doing that. They're willing to travel and do that. They were willing to move about and travel about, taking the level of precautions that were appropriate for them. Social distance, wear a mask, but yeah, I'll get on a plane with a mask. Kind of figuring that out for themselves. No different than when the schools were shut down in the spring, everyone had their kids at home, right? Remote learning. This time around, they started creating things like pods and cohort groups and things like that to kind of give them that social experience with some level of COVID protection. It's amazing how people figure stuff out. People figure out what's right for them and their loved ones. They figure out how to navigate their concerns about the virus with their desire or need to live life in a certain way. And when I say live life, I'm being really broad here. The level of education they want the kids to have, the level of social action they want them to have, level of opportunities, because it's not just the virus, it's also the mental health, the social aspects, the financial, economic aspects. All of this is driving people's behavior. I had a number here earlier about real estate. I should probably mention that one. Let's see, construction activity, this is this week's data, is actually above the pre-COVID levels. More construction on national than above. Not tremendously, but above. But here's a fascinating one. Home sales. Pending home sales are 112% of the pre-virus level in late August. Okay? They were at in April, they were at 62% of pre. So you see the difference there. So people are moving. People are either remodeling. Based on the neighborhood I live, it looks like just about everybody's doing some kind of remodeling their homes to make them more, I guess, I don't want to say larger, but adaptable to the current environment of kids at home, family working at home and whatnot. their yards because they're going to spend a lot more time on home, or moving to an area that is more desirable to live in. Again, given the fact that they may not have to commute to work every day. So only time will tell how much of this is permanent, but it's one thing to rent a house somewhere. It's another thing to put the expense of remodeling or buying a house somewhere else. If I have time, I did want to touch on there, and unfortunately I didn't get all the data on this. There is one interesting proposition in California that people might want to take a deeper look at. And I apologize because I didn't get the exact information, so I'm not sure if it's Prop 19 or not. But it's the one about the property taxes and the ability to transfer your property taxes if you're over a certain age to a home of equal or lesser value, which is something as a financial planner I've wanted to see for years, because it's wonderful. A lot of people stay in their homes and don't move because they can't afford to do it, right? They sell their home, they move to a smaller home, maybe near the kids or, in an area that's better for them at that stage of their life. And then they have massive property taxes, which is a killer when you're living on a fixed income. So they stay in this giant home and then just wait till they die and the basis resets and their kids get it, right? That's been the way it's been. In some counties will allow some degree of that, but not really, there's not been widespread. And it sounds great, right? Oh, wonderful. People over a certain age, keep their property tax, buy lower house. But there's a catch to that, which I don't even know how ethically you can squish these two things together. I don't know who makes these decisions, but it threw me crazy. Is California's version of the inability to reset your basis upon death or transfer. So please look at that initiative very closely and understand it has two pieces to it. Again, that was the preliminary. I don't know if any modifications have been made, and make the decision that's right for you. But it's one of the things where they literally took two things and merged them together, and they're totally different subjects. So keep that one in mind. If it passes that one, no matter what it passes, if it passes at all, it's going to require people to rethink their financial plans. So watch that one. I think the most closely of all the pile of them I've seen so far.
And then earlier you mentioned, there's these embers brewing out below the surface. So there's a question here about there's been some large cap bankruptcies like Hertz and others. Do you think those economic impacts have been kind of priced into the market, or will there be some additional things that we should be looking out for?
Oh, there'll be more. Two reasons. Number one, a lot of companies have a very high debt levels. That's something that's been a concern. And in a good economy, nobody cares, right? As long as you can manage your debt, have the money coming in, fine. You can have all that. So companies, some companies created debt to buy back their shares, others for acquisitions, others for other reasons. But there's a lot of companies out there with tremendous amounts of debt. Okay, and that works fine when the economy is booming and the revenues are coming in. Does not work well when the revenue falls off a cliff. So there's a lot of companies out there struggling. We call them zombie companies, and they're struggling, and they're in all sectors and they're all over the place, and they will likely fail unless they figure it out, or they're going to get acquired by somebody, for not very good prices. They're not going to figure it out. In addition to that, because of COVID, there are companies that just simply don't make sense in the environment. As I said before, and about COVID, is that we have pulled forward. Technological innovation is pulled forward. A lot of these companies were going to die anyway. They're just going to die faster now. Okay, so that's kind of a risk. And your individual investors in group probably are familiar with the term value trap. That's going to catch investors a lot because they're going to see, oh, this is a really good, solid, long-term blue chip company paying a great dividend, and it's cheap, so I'm going to buy it, and it's great investment. But these companies will die. Not all by any means, but they're going to die. There's a reason. So be careful of what you invest in and their prospects going forward. So on one hand, a lot of them are just being basically cannibalized by the tech companies. Their business being taken over, and it's just going to be done by other companies going forward. Consumers are doing things differently, and these companies are better prepared to meet the new consumer way of doing things than the old than the company is. Another one, though, is on the other side of it, is there's a lot of companies out there that are rapidly adapting to technology and innovating, which is what I'll talk more about later. So not all of them are going to die. Some of them are going to figure this out, and they're going to eat their competitors' lunch. So it's really interesting. It's all about adaptation. It's all about adaptation. The large companies struggle the most because it's hard to turn the tanker quickly. But there's certainly, as I said, that there's going to be the effects of, I don't say the effects of COVID. Officially, from an economic perspective, it's not the COVID as much as it is the government shutdown. If the government hadn't shut down and COVID had just ravaged through, our country, there would certainly be a huge economic impact to it. Certainly, because obviously when people are afraid of dying, they're going to do a lot less stuff, right? It's the reality of it. But the government shutdown kind of put that other layer on top of it because it was sudden. And again, I'm not putting fault here. I'm not saying it was the right or wrong thing. That's other people's conversation. But the suddenness of it gave companies no time to prepare. Right? Just no time to prepare for what do we do in this situation. We all probably saw the videos of all the food and all the livestock that was just destroyed, right? Because it couldn't be distributed. Our supply chain in this country is woefully inefficient. And that was laid to bear with the toilet paper story. It's not that we don't make toilet paper. It's not that it's not really easy to make toilet paper. We have all of the raw materials for it. The supply chain was the issue when all of a sudden we went on a toilet paper hoarding frenzy, which we'd never done in history. So no toilet paper companies out there going, we have a plan for that big surge in toilet paper. They don't do it. They plan for the surge in Christmas. They plan for the surge certain times of the year. They don't plan for that surge of something that we use pretty consistently until we don't. and it was much more of a supply chain issue than it was a lack of resource issue. And that's it. So companies, again, figuring out it's not just going to be COVID. There will be more events in the future that will change things as well as the behavior. But in these times, I have clients all over the country. I'm a certified investment management analyst and economist. I have CFPs on my team that work with me with all my clients. We are fee only though. So our firm, and again, I'm not here trying to promote or sell to anyone. I'm answering the question that was presented. We basically have a menu of services and people pick what they want to pay us for. So we have no products for sale. We have no agenda. People just pay for whatever they need. And what they need depends how we build out the team. I hope that answers their question. But yeah, we are definitely fee only. So you can manage your own investments and still talk to us if you want to.
What do you think about investment grade corporate bond laddering?
Not know if they mean laddering by yield or laddering by credit quality. So I'll focus more on credit quality. And you always want to do that because even in good economic times, there can still be companies in trouble. It's not like there's not bankruptcies, corporate bankruptcies, or corporate debt issues, even in good times. I mean, look at Kmart, look at Sears. I mean, this was all pre-COVID. So you always should be keeping an eye on it, but certainly laddering by quality. I do this all the time for clients. I'll build a municipal bond portfolio for somebody, and I need to know what the yield they need, what's their time horizon, and what's the risk factor that's suitable for this. But to go into the higher yield space is perfectly suitable as long as I have really ascertained the client's risk. As you all know, it's a trade-off, right? You can be super conservative. But even with the ratings, remember, rating agencies are not as fast as companies' balance sheets can get much better or deteriorate. They just can't be, and they can't be. So the rating agencies is certainly something to look at, but confidence in the person who's selecting those funds is important. If you're buying the bonds on your own and laddering, it all falls to you. If you're doing it through a fund, be it an ETF or a mutual fund, then your confidence and your communication with that fund manager is really important. In other words, I say communication. It's not like you're calling up Vanguard and they're going to talk to you, but the content that they present to you, are you comfortable with that? And I'm not picking on any company here, just an example. Vanguard in their National Muni Fund has really loaded up on New York. I think it's New York Transit Authority. I might not be calling it the right name, but the people who run the subway system in New York, they're in desperate financial trouble right now because obviously people aren't riding on the subway. Desperate. I mean, they're ready to, those bonds are ready to fail. But Vanguard is very confident. They have high level confidence that the federal government would never allow the New York City subway system to fail, and they're going to get bailed out. And they bought up a ton of their bonds. So you, knowing that information, can decide, do I feel confident in that or not? Another company, and again, I'm not picking on companies here. I'm giving examples, and I'm not in any way saying to or not to invest with them. I believe it was Franklin went out and bought up a ton of Puerto Rico debt, right? When Puerto Rico was getting a little dicey. And that did not end well for them. It was a great yield. The fund was doing a great yield. Oh, Puerto Rico will never default. They're kind of like one of us. They're like our 51st state. Well, apparently they can. So, that's what your confidence has to be in listen to what the managers are saying and see if you agree with that yourself. Do you agree that New York subway system is going to get bailed out by the government? great, then go with that, with the Vanguard fund. If you think that Puerto Rico risk is willing to take, then great, go with that Franklin. But know that, because that's the only way you can know if it's appropriate for you. You don't want to get surprised saying, I never thought that Vanguard would do that to me. They're so nice and friendly. Well, but they're making a choice that's right for their fund, and they don't know you and what's right for you. And so that kind of falls a bit to you. Or again, if you have a professional, if you have someone like me or someone you work with, that person should know. That's their job. That's what you're paying them for. So but again, assuming you're all individual investors, I'll say it falls to you.
Now, do municipalities provide periodic reporting? And what financial ratios would you use to analyze the financial data from these municipalities?
The answer is yes, they do. And there's the Municipal Bond Securities Rating Agency. This information is available. You can go get it online. Now, the other thing is what you want to look at depends on the type of bond. So there's general obligation bonds. There's some bonds that are special purpose bonds. There's some, what I want to say, like water and sewer. They're kind of like really stable, but they tend not to be yield as much. So you want to see what is the source of the revenue to the bond and what security is in place for the bond holders. Like if that portion, that whatever the revenues come from the bond ceases to exist for any reason, will the general fund of that city or the municipality or the state, will that make the bond holders whole? Are you guaranteed? Right? Is there another source of guarantee, another layer? Now, the more guarantees you get, the lower the yields are, obviously, risk to return. So you have to trade that off, but you'll be able to look at that and say, okay, well, wow, you know what? I have this great bond, but it's backed by a sports stadium. There's a lot of those out there, believe it or not, municipal debt backed by sports stadium, backed by airport revenues. Okay, wait, that might be making you a little nervous about now because there's not too many sporting events going on. So what's the risk to you? That's what you want to understand, and that's the information you want to look up. Is this backed by anything else, or can this bond default? Can this bond actually default, or just even if it doesn't default, does just simply not pay revenue anymore, which is technically a default, and maybe at maturity I'll get my principal back. And again, trade-offs. That's where diversification comes in. You just a little bit of everything, and you have less likelihood of that. But know the source of the revenue and know what security is in place for the bond holders if that revenue doesn't materialize. High level example.
Got it. And then a broad question. Do you see impact investing as creative, destructive, or both?
Oh, both, most definitely. I see that a lot with with community capital management and other things that we use. So I oversee funds for a lot of nonprofit organizations and a lot of groups with defined missions. And a lot has come around recently of racial equality. Okay, that's been a big hot topic. So maybe a little bit kind of expanding on the traditional socially responsible, but that's been a big thing. So companies and individuals come to me and say, this is an important issue for me. I want to support it in my investments. And that used to be a relatively small subset of investors in the past. In recent years, it's become more and more and more important. Now, investors don't want to trade off. They still want to hit their objectives. They still want to make money. They still want to achieve the goals of the portfolio. But if they can do that and also support, let's say income inequality is a big issue. There's plenty of things you can invest in through the government that focus on, say, Section 8 housing. If racial equality is an issue, you can focus on investing in minority-owned businesses and things. And these are also good investments. They actually make money too. So it's not just putting money into something to feel good. There's a financial reason behind it as well. So I think it's, the tail wags the dog or the dog wags the tail kind of thing. An issue, it comes up, it becomes important, it becomes important people. They come to people like me and say, this is important to me. Usually they stop and say, will this make money? Now, another thing that's interesting is that even throughout the COVID time, you look at a lot of this, and actually a lot of these funds were doing very, very well on their own for a lot of reasons. Again, a lot of exposure to technology and whatnot. Some of it has to do with where the government's putting money. So if Biden gets elected and if he shifts more to the more progressive side of the Democratic Party and focuses a lot around climate change and climate issues, you could see a lot of the green funds, the green-related funds do very well. So sometimes it's to do with, again, politics, where money's flowing. But ultimately, investors speak with their values because they will come to me and say, these are the issues that are important to me. If I can ethically put it in their portfolio, when I say ethically, my highest responsibility, I'm a fiduciary. As a fiduciary, I have to have my clients' objectives above everything else. So I have to tell them, okay, we can build a portfolio, because I can show them their portfolios before we invest. We can build it this way. We've got a 30% focus on the areas that are most important to you. Here's the probabilities going forward with this portfolio. We can build it this way with a 10% ratio. Here's the probabilities going forward. Which would you pick? Most will still pick the one that's going to give them the most growth, but there are a lot of people who say, you know what? I'm going to go with this because I'm going to feel better about what I own. You know, I already support this cause. This is already a strong belief of mine. If I can do it with my money and make money, this is where I want my focus to be. And it's a pretty cool way. So it is something where I said a lot more of the investors are wanting to do these things, provided, again, it's not financially harmful. So it doesn't mean you have to take all your money and put it into something that's unproven or unknown, because it might be the next source of energy. It can also be well-established companies that are doing a lot of really good stuff in whatever area is most important. I would do a checklist. I have a checklist for my clients, try to figure out what areas are most valuable and important to them as well. Because there's a lot of stuff that says, oh, we're a socially responsible fund. Well, what the heck does that mean? Right? That's a pretty broad category. I have a fund that's socially responsible that is totally Catholic run. It has all the Catholic belief systems in there, and they support things or don't support things based on the Catholic beliefs. All right. Well, so let's use, for an example, birth control. Absolute no in the Catholic fund. Absolutely yes in a lot of funds that want to give women a lot more, especially women in third world countries, a lot more control and empower them. Right. There you go. So the two different ideas of socially responsible. So make sure that your values are lined up. Nothing worse than having that socially responsible fund and you're like, what the heck do I own? What am I supporting? And you should be able to do that. Again, you can do your own work on this, or you can talk to the person that is advising you.
But in terms of impact investing, is there a way to quantify the popularity? I mean, are we looking at, 5% interest, 30% interest in terms of like just the client base being interested in that kind of investing?
I would imagine, I don't actually know the number. I know it's increasing rapidly. I know I see it personally. I know also within the investment and economic communities, it's increasing rapidly. I mean, like exponentially rapidly. I don't know how to quantify the number of people who have an interest as opposed to number of people actually go forward with the investing. Also, a significant number of investors are invested within their company's 401k plans, in which case they may or may not have choice. And then another significant portion of investors have no idea what they're invested in. Okay, you guys are not those people. I know, but there are a lot of people that have, they leave a job and their 401k is still at the old employer for 10 years later, right? There's no real connection to what they're invested in. And there's a much smaller portion of people that are actually really engaged with their investments. So that's why I think that of all investments out there, the number is probably relatively small, but the amount of people who are engaged with their investments, I think the number is pretty, I would say it's safely 20 to 30% have some form of I support or I like this and I want it in my portfolio. And again, that's my assumption and I have no data to back this up. So please take that out from the things I do have data for.
Got it.
So if I may add one thing, it's that there's a lot to be said. When your intention is lined with your values, you just feel better about what you're invested in. It's just the way it is. And again, a wise person, a wise guide can help talk you through the pros and cons of that decision. But it's just something about it. And when you can align your values and your intentions, the outcome is usually better. And you feel good doing it in the meantime, whatever that means to you.
Got it. Well, do you have any good books or other resources that can talk about impact investing that you've come across that you really like? I
do. I can follow up with some ideas. I don't have them off the top of my head. There's also some really good books about, one book I really love because I'm a strong believer that we can use capitalism for good without having to take from one group and give it to another group, which is the narrative, right? These people have too much money. We need to take it from them and give it to them, which creates conflict, creates defensive conflict between the two groups. So I worked hard. I earned this money. Why should I give it to you? And this person's saying, you have too much. That's not fair. Give it to me. No. And there's this back and forth narrative, and the politicians, of course, stoke it all the time, but it's not a zero-sum game. There's no limit to the abundance that's possible. And I say abundance transcends the financial aspects of it. True abundance. There is no limit to it. It's the scarcity model is used to control people. If your neighbor is a billionaire, it's not why you have $10,000. There's no correlation between that. You know, Bill Gates, Elon Musk, the like, they're not making you not be where you want to be. There's many other factors there. So there's some people who have found ways to use the current capitalist system and in ways that can help, minimize income inequality without, throwing the baby out with the bathwater. So one book I recommend reading, just because as individual investors, you'll probably love this, the concept behind it, is Citizen Capitalism. And it's about the unified fund. And it's a way of doing this, and it's all voluntary. That's the best thing. You don't have to do a thing. You can think the whole thing sucks and you don't have to do anything about it. But I love it because it actually is one of the most brilliant ideas I've ever seen of helping minimize and helping to not, it'll never go away. The United States is a land of opportunity, but it doesn't mean everybody will have the same outcome. But it can minimize a lot of the effects of it, but it's all voluntary, which is beautiful. Anyway, citizen capitalism is one. On the sustainable or impact investing, there's a lot of good books on that, but they tend to focus on certain areas like the environment, okay? Again, social equality and things like that. So I can think of a couple of them and get back to you with some names. Ultimately, there's some great screens to understand it. And if someone is really into that, if I can, as long as, again, I have to take care of my clients first, but if I'm able to, I'll kind of help screen it or help point them in the direction when I know what their passions are. Because it's something I really love to see people when they line up their investments with their passions. And it's good to do. It's good to be able to just really understand what you own and then make those decisions for yourself. The second portion is twofold. Number one is to talk a bit about some pretty stunning things that are happening in the world of innovation. The speed in which innovation is taking hold across the country, around the world, I should say, is at a pretty rapid pace. And I'm going to give some examples about that shortly. I want to talk about that because as investors, these are going to be the things you're going to want to see and understand. And my purpose today is not to tell you what to invest in or what the next big hot thing is going to be. It's more so to show you trends that are taking place, already happening, okay, kind of behind the scenes. Some are more known than others, but are going to fundamentally transform our economy, the way we do things in the very near future. And I'm going to start with repeating something that I said earlier in the Economic Outlook, which is this time of COVID has brought forth 6 years of technological innovation and adaptation in 6 months. Back in March, we were all shut down. Everything was shut down. We were suddenly overnight forced to do things differently, figure out how to do things differently, and in an environment that we'd never been before. How I'm communicating with you right now was unknown to many, many people, or at least unused by many, many people just 6 months ago. Now it's a regular way of not only people communicating, but also people working. Jobs that would have been lost had the COVID crisis or the pandemic hit us back in 2000, companies would have been forced to lay off their employees because they couldn't come into the office. They would have been forced to shut down completely because they weren't allowed to do operations, to be in business, unless they were deemed essential. So imagine for a moment that 2020 was pushed to 2000. Companies would have had to close the doors and maybe furlough, but probably eventually terminate their workers and shut down their operations completely. Innovative companies were able to figure out how to work in a rapidly changing environment full of uncertainty, and at any moment it could be different, and they did. And most of them who did it through technology. Technology allowed not only essential workers to continue to work, think about telemedicine to talk to your doctor and other things, but it also allowed companies that were non-essential to continue operations, keep people employed, keep people working, and keep them safe during this time. And this is pretty rapidly, but it also forced this rapid change happen very quickly, and it pulled the future, roughly 5 to 6 years, depending on the day you're looking at, into the present. And that is why in the markets now you're seeing, at least early on in the recovery, the most of the S&P 500, the recovery that we saw was 5 companies. 5 companies that were well positioned for the environment that we found ourselves in. But that's just the tip of the iceberg of what's going on. Because even before this, it was rumbling below the surface of these rapid changes. And you do see things and you say, wow, that's really interesting. But it's happening not in one area, in one sector, it's happening across the board. In the past, when we had, society changing innovation, it was usually one thing, one sector, One idea and it transformed everything. Imagine the electric light bulb. Imagine electricity. Now people could work in the dark hours. People could, they had access to electricity. Imagine the car instead of the horse-drawn carriage. Okay, which is I saw an interesting commentary once about how afraid people were of cars, afraid of them. They were so dangerous when they first came out. Oh my gosh, that new technology, it's dangerous. And look today. Now we have autonomous cars that can essentially drive themselves. And semi-autonomous already available and autonomous coming along very, very shortly. How will that transform our lives when you no longer have to drive unless you want to? So there's many, many technologies, many areas, but the innovation I'm talking about today, I'm going to touch upon some of these areas, but I'm also going to talk about this is not just looking at the companies and trying to figure out who's going to be the next Tesla, who's going to be the next Zoom, who's going to be the next Amazon or whatever. Look at it from this perspective is which companies that are already there, who is adapting, who is innovating, who's going to be ahead of the rest, because the speed in which it's changing, slow, large companies that can't reposition quickly are going to become dinosaurs. Companies that have been with us for hundreds of years are going to go away. And other companies that have been with us for 100 years are going to stay and thrive. And they're using the technology, they're using artificial intelligence, they're using machine learning. Okay, they're using a lot of these technologies that are available to us. The blockchain, it's not just for Bitcoin. It's not just for cryptocurrencies. Blockchain and blockchain related technologies are fundamentally reshaping the financial services industry, logistics and distribution industries. A lot of traditional businesses are rethinking how they're doing things and using this technology. What does that do? It takes out a lot of intermediary companies. Companies that once essential to do operations go away. One area that's really was exposed, as Warren Buffett likes to say, when the tide goes out, you see who's been swimming naked. Well, we saw who was swimming naked in COVID times. We haven't even seen all of them yet because some of them are still crunched down in the water with no shorts on. Those will pop up over the next year or so. The ones that we have started to see are the companies that were really just patched it all together. The supply chain was a really big person who was swimming naked. Okay, supply chain. I was talking about this a bit earlier, but I'm going to expand upon the toilet paper story. So we all know what happened about the beginning of the COVID times and the shutdown and whatnot was toilet paper. You couldn't find it anywhere. Toilet paper, right? People were hoarding that like there was no tomorrow, and it disappeared off the store shelves. And it took months to get back to somewhat toilet paper normal. It's not because we can't make it. It's not that it's hard to make. It's not that the raw materials to make it are not readily available. It's the just-in-time supply chain theory, which is we know how much we need, we know where we need it, we know when we need it, and we're just going to order it exactly that way so we don't have to store it anywhere and waste valuable resources in storage. And toilet paper is something that Americans, we use pretty consistently. Maybe it goes up a bit with our population, but there's not too much variance in the frequency of our toilet paper use. So stores were able to predict that very, very precisely until it's not all of us maybe, but many of us all at once decided that we needed to have years worth of toilet paper now and went to Costco or went to wherever and hoarded it. Or I'm going to be hoarding, maybe it's a little harsh of a word, but stocked up on it. And then now there's not enough. And then what does that create? People go in the store, they don't see any toilet paper, then next time they see it, they start to stock up, right? So it's like this spiraling thing of this fear of scarcity that caused people to buy a lot of it. And toilet paper doesn't go bad, so there's no downside of having a few extra rolls. But it was a supply chain issue. There's the places that make the toilet paper, you need the wood pulp and you just need to make it and then you need to ship it out. And it took a while, but the disruption was on the supply chain and on the production levels. Imagine a world where you instantaneously could predict in real time your needs and shoot that straight to the factory that's producing it for you. That you didn't have all of the people within the distribution process that you would have to work with to get it. Your local distributor, this and this and this. There's a lot of, the technology exists. It wasn't used. Why wasn't it used? I can tell you when I talk to my clients about it who are in this space, that's a lot of money to spend. And we don't know if we really need it. Well, they found out that they really needed it because guess who has a really rockin' grid job on supply chain management that just is on top of the whole thing? Amazon. So Amazon, even with all of the disruptions, maybe at the supply level, Amazon was able to do a pretty dang good job at getting stuff to people. Yes, there were slowdowns. Yes, you didn't get it in 2 days. Yes, they focused on essential goods to, essential services, but they were still operational and able to function even when all of the supply chains were messed up. They were able to figure it out. Why? Through technology. Through technology. By the way, something I was going to mention earlier is 40% of the people that used Amazon for their first time ever during the pandemic will continue to use Amazon after the pandemic's over. They found it to be super convenient. Doesn't mean they won't go to their local stores here and there, but maybe not as much as they once did, and maybe only to certain stores, because there's a convenience factor. When you try it, you kind of don't necessarily want to go back. So that's going to really fundamentally affect, again, a lot of the retail sector and whatnot. So that's an example of one. Now, the supply chain has a lot of areas. Again, it's got the artificial learning area. It's got the robotics. Okay, so artificial learning is a little bit different than artificial intelligence, but robotics in some form or another are going to transform a lot of things in a very quick order. Okay, and then robots are not necessarily things that are moving around pulling packages off of racks like you see the Amazon robots and whatnot. I've been to an Amazon warehouse. That is one spooky place of efficiency. Not 1 square inch is not doing something. It's incredible to watch. But beyond that as well is robots don't get COVID. And if you think COVID's the last time we're going to have some disease outbreak, even if we have a little disease outbreak in the future, not nearly as big deal as COVID, people are going to be scared to death, and there's going to be some form of shutdown or limitations because we're hyper aware. If you don't believe me, think about 9/11. We didn't think too much about terrorist attacks until after 9/11. And for quite a while after 9/11, we were highly sensitive to anything that looked like it could be a terrorist attack. And we changed our lives until we sort of forgot about it after a while, and they got rid of the terrorist alerts and the rest of it. And saying we as a society, not saying anybody specifically here, but robots don't get COVID. Robots don't need a robust benefits package. Robots don't get sick, don't show up to work drunk. They do a lot of good stuff. And please, with the full respect of workers and all the hard and great work that they do, I'm speaking here purely in technology innovation and to be very practical about this situation, but a little bit funny at the same time. So there's a lot of advantages to being able to use robots, and some of the meatpacking plants that were using more automated technology were better able to adapt to the new COVID restrictions about keeping people more separated. Whereas ones that were doing things the old way with people shoulder to shoulder chopping up the meat were forced to close, especially when they had outbreaks. So which meatpacking plants were able to command the highest price for their product when scarcity started to hit? The ones that were able to stay open and still comply with the rules. So using robots in some form or another to do some very simple activities is just exploding right now. The orders that are coming in, the interest and the demand is exploding right now as companies are looking, how do we plan if this happens again in the future? In addition, what worker out there wants to do a repetitive job day after day, month after month, chopping pieces off of a cow, putting parts on a car, do any repetitive work? It's not a job that gives people a passion. It's not a job that makes people feel fulfilled or happy. It would be so much better to have those jobs done by machines, and other people that are doing those jobs can do something else and something better. In fact, a really good one, learning how to maintain and care for those machines, because robots do need care, they do need maintenance, and that's something that can be done and trained. Far more interesting intellectually and personally fulfilling probably, again, than chopping wings off chickens all day. So that will still provide job opportunities. It's just having people do different things. It does not need to lead to a widespread unemployment situation. And again, I'm being simplistic here, but my purpose spoken on innovation. So that was just, I wanted to kind of talk about that sort of at a high level. The other thing I wanted to mention is the other areas. So electric vehicles, really fun one. We know a lot about them, so I won't get into details. But imagine a world when we do have fully autonomous vehicles, which is not too far away. It's not too far away at all. Imagine a world when instead of everybody owning 2 cars on average for a family, people owned, half the population roughly owned a car, and they only owned 1. And when you're not using your car, which is about 90% of the time your car is sitting parked somewhere, your car was able to run around and just basically be an autonomous Uber. People who have the app on their phone could call your car comes, takes them where they need to go, and then goes back to wherever you left it. Okay, it would have a tracking system. You'd know exactly who's in your car, so they did something they shouldn't do. Obviously, you would know how to, to follow up, do whatever's necessary there. But that being said, your car could be a source of income for you, just like a rental property. Your car could be running around, moving people around all day. Other people, especially people living in dense urban centers, could choose to no longer own a car. I was in Boston once on a business trip, and somebody told me that if you want a place to park your car there, it was like hundreds of thousands of dollars to buy it. Like literally, like almost the price of a house to buy a parking spot in Boston area. Maybe there are higher prices elsewhere, but that was pretty shocking to me. So you're in a city and you rarely need your car because you're going to use public transportation or walk most of the time, but you still want one because sometimes you want to go to the countryside or go out of the city. There you go. Think how much money you'd be making on your car when you're rarely using it. So if you wanted to park it. Now, if you live in the city and you don't want to pay for parking and you don't want to own the car, you just call the car when you need it and you go wherever you want to go. This sounds fantastical. It is literally in development as I speak. It's really in development as I speak. The great value of Tesla is not the cars necessarily. It's the data they have. It's their platform they have. All of that data and all of that information they have is why they're leading the pack with the innovation in relation to autonomous vehicles. And that is the single greatest value of Tesla. And the stock price will probably be significantly higher in the future because of that, just because of that alone. So I wanted to talk just that different view of autonomous cars is imagine if it was your income in your retirement years, your car's earning money for you. Another thing that's seen big in factories right now is 3D printing. Now, 3D printing was really hyped in the past and sort of fizzled out. On an individual level, yes, it's not is probably going to make that big of a difference, but it's being used in factories all over right now, and that's also ramping up very quickly. Reduce the cost of production. It increases the accuracy of production, and the technology is rapidly improving. So 3D printing in that space. Again, these are not necessarily investment ideas as much as big trends that are taking place. So look to the companies that are adapting. What you may have noticed, maybe just me because I'm a geek, the FAA just recently approved Amazon to use their drones without actually having to visually watch it. So the FAA rules around drones was that it had to be in your eyesight, which isn't very practical to have that drone bring your Amazon box to your home. Apparently that's no longer the rule. And so that's going to give a lot more flexibility. So the day in which Amazon delivers drones to your packages by drone reduces their cost significantly and also speeds up their accuracy of delivery. So that's happening. That was a big move on the FAA's point. Okay, I'm going to jump in a little bit into healthcare. I'm not as much of an expert in this area, so I'm not probably going to use the right terminology. So any of you medical professionals in there, feel free to pop up on the Q&A and correct everything I'm about to say. But DNA sequencing is a big deal, and this is creating now and will create massive breakthroughs in the way that we treat people in the future. One of the greatest challenges in healthcare has been is that even the best treatments, cures, be it a drug or a process, don't work on everyone. Why is that? We're all different. If everyone on this call had the same disease, we would all be treated differently because our bodies are different. If we broke our arms, probably be about the same. If we have a different type of a disease, a cancer, something like that, the treatments would be different. Maybe it's our age, maybe it's our gender, maybe it's this, that, beyond my scope of knowledge. But that being said, DNA sequencing, now they're starting to learn how they can customize treatment, customize cures, customize process to individuals. This is fundamentally reshaping a lot of areas of healthcare, and that's an area to watch closely. And the efficiency of R&D is also, with all of these technologies I'm talking about, getting better and better and better. Some of what they're working on with the COVID vaccines, they're using existing technology that can be replicated to different diseases, to different viruses, right? That's why they're so far ahead on the process of a vaccine than they ever ordinarily would be. Information, and they can replicate quickly through technology. Some countries say they already have a vaccine. Only time will tell how viable that vaccine is. And also all countries have, of course, different process for testing. But that being said, we would not be where we are now with the COVID vaccine if we didn't have the R&D technology and the efficiency and the speed of which we do now. Last area, because I'm saying a lot super quick. Sorry, I hope you guys aren't trying to write this down. FinTech, so the technology around the digital wallets, around Bitcoin, question I get questions asked, two different categories. I'll touch upon cryptocurrencies first. There is definitely a future there, and they're definitely going to be a big part of our future. They're not there yet. They're not there yet for a number of reasons. Accessibility and volatility and risk being the biggest components for the average person. Play in that space if you will. There's a lot to be said for it, but it's not there yet. It's not going to replace the dollar. It's not going to become the reserve currency. It has a ways to go. I can give you a whole story of why. I'm not for it. I'm not against it. It's going to be the future, just not quite yet. Digital wallets, on the other hand, are, and that's rapidly changing. And this is actually going to be very disruptive to the financial services industry and the traditional banking sectors. And you're seeing that now, that the market share being grabbed right now by digital wallets from traditional banks is rapid, it's massive, and that's going to happen faster than people expect. And so that's something to keep an eye on, especially if you're an investor in some of the larger banks. Not all banks are created equal. Some are going to be just fine, but there's others that I think will probably not be with us that much longer, or at least in their current structure. So I'm going to read this to you because this is probably a very good thing to consider for all of us in this process. What does this mean to me? And then I'll jump a little bit into the investing side. Oh, sorry, I'll stop for questions and then jump a little into the investing side. And this is the story here. So think of it this way. In today's economy, we are the raw materials. Our attention, our behavior, our data have been the most valuable commodities in the world. Therefore, it's not surprising that a handful of companies have excelled at commanding our attention. Think about this. Influencing our behavior and using our data to dominate the economy. Nor is it a shock that fear of this concentrated power and influence has resulted in increased calls for regulation and antitrust investigations. The scenario has unfolded many times throughout the history. I mean, we've had it. We've had these great leaps of industrialization and the steam engine and railroads and this and that. Well, all of a sudden we make this great leap forward in technology, but it used to be one thing, one area that suddenly changed. Think what the railroad did to the United States. Think what the steam engine did. To the railroads, right? Think about what electricity did. Think about the automobile, all of this massive transformation that we had in our nation and the world, but I'll focus on our nation here because of innovation and technology. This time around, this massive leap forward is happening across sectors, across areas of our lives. Right now, you can see your doctor without going to your doctor's office, telemedicine, right? That was hardly used before COVID. Now it's very commonly used. Very few people are going to the doctor's offices. So many things are changing so rapidly, it can be very, very disruptive. But the core of all of this is it's us. It's us doing stuff that's providing the fuel for these companies to continue to grow, to continue to expand, and get into more and more of our lives. So what is it? They would say, if you can't see the product, you are the product. Well, in this case, your behavior and where you focus your attention is how these companies are grasping all this. Again, confidentially, privately, I would imagine for the most part. There's probably a whole other argument, but this is how things are being adjusted. Our collective behavior is pushing the direction of where technology is going. If we want it, if we're doing it, that's where the energy is going to go. In the olden days, again, I'm 51, so let's say the generation before me, or even maybe the beginning of my generation, you got a job and you worked at that company, and your skill and your pay and your value was the more years you were there, the more valuable you were, and the more you got paid. Until that day, they gave you the golden watch and you rode off into the sunset, right? Well, nowadays it's sort of flipped. The longer you're with a company and the older your skill set is, the more irrelevant you are. It's just the reality. I'm not getting into the right or wrong of that. It's just kind of flipped in this environment. So the challenge is how do you stay, current and relevant on your end and keep up with the skills? It's no longer just you've got this position because you've been there a long time. Now there's exceptions to that. The government, academia, there's a lot of places where you're kind of guaranteed a job essentially if you've been there for a period of time, but that's not the case in the public sector. Then the private sector. So that's a consideration on that end. It comes to our education system for the most part, and I'm not picking on it in any way. I'm not an expert in it, and I'm sure there's a lot of viewpoints here. Training people to be adaptable and flexible and not rigid, I think, is going to be critically important. Young people are naturally flexible. They're naturally adaptable. They're naturally adjustable, and something happens as we get older and we start to get more kind of calcified in our ways. And I'm pick on myself here too. I think it's kind of how it goes. That will have to be changed. But young people have that flexibility and adaptability. The skills needed to work in a lot of these sectors. You do not have to be a tech genius. You do not have to be an engineer. You don't have to be a computer programmer or scientist. You don't have to have the highest levels of STEM skills. Not everybody is capable of that. Not everybody will do that. To do a lot of the jobs that will come out of this new economy does not require a high level of educational ability, but it does require a degree of training. I watched a program to train people how to manage robotics, how to make sure that the machinery, automated machinery, was working well. And the people that were in this program, for the most part, did not have college degrees at all. The people that got out of high school, maybe even with a GED, and were learning these skills. Does not have to be complicated. We just have to think differently. And we have an idea that, we say our kids, you can be anything you want to be, but then we spend a whole heck of a lot of money paying for that education. And the balance is that whatever they learn from this education, is it adaptable enough that they can adapt to this rapidly changing economy? Can they learn? I had a client years back that had been doing an office job her whole life. She was in her 60s, and she got laid off from her job, and she had never learned how to use Microsoft Office in any of its capacities. Never learned to use, even just a rudimentary computer. And because she didn't have that one skill, nobody would hire her. So she was done. She just couldn't get a job because she didn't know how to use Microsoft Office. And that was a while back. So imagine going forward. So the one thing I can say with anyone, whether it's a young person or a person, is keep up with the skills necessary in a changing economy. Also for you, it gives you the most flexibility to do more things if you no longer want to do what it is you're doing now. Right? You can do something else in the future. But for the young ones, just be adaptable and make sure that you have those skills. I think young people's education is going to be so different, especially after this year. And who knows if they're doing that. But the mismatch, when we see now, it's a mismatch in skills. It's also a mismatch in abilities. And that is something will change. But the jobs of the future are not all going to be jobs where you have to be brilliant. Computer scientist, programmer, engineer, stem cell degree. There'll be plenty of other opportunities out there beyond that. Principle, not knowing people, I'm not going to say invest in this company or this company. Look to what the company does and what they're focused on. And there's kind of two extremes of this. Like one extreme is it's a new startup, it's doing this great thing, it's going to change the world. Higher risk, potential higher reward, but there's also could be more failure on that side of it. Okay, all the time. Oh, they're doing this great thing. If they're doing a great thing and if it's starting to be widely used, the next consideration is how wide of a moat, we call it, is around what they do. So Tesla, for an example, there's a huge moat around them. Their competitors can't even remotely do what they're doing. Their competitors are making electric vehicles and they're not really doing nearly as well as Tesla is. And Tesla, before their factory in China, they had one manufacturing plant. And look how widespread Teslas are. Look how big that company grew with one plant. It's still amazing. I've worked with Tesla for years, and I've been to their factory since the very beginning when they were just this little tiny corner of that giant NUMMI factory, and now they've got the whole thing. They had the whole thing. They only could use a little tiny corner because they were so small. So I watched them grow as a company, and I still just logistically am amazed at what they can accomplish with that one place. Again, I know about the Chinese factory and whatnot. But that's an example. But they had a wide moat because they were so far ahead technologically, and also, I guess, what car people call the cool factor, how fast it could go, this it could do, that it could do. But they were so far ahead of their competition that they were chasing Tesla. Remember, it's like they always said, oh, the next Tesla killer, and didn't go anywhere. Now, eventually, they will. They eventually will have other car companies that will be competitors to them. But they had a huge moat. It was hard for someone else to come in and start taking over. Apple has a huge moat around them. Okay, this is not a recommendation to buy the stock. There's a lot of considerations with that company right now. But they have a huge moat because iPhones are so prevalent. It's just so easy for them to continue to speak to their audience, regardless of what else that they do. Other companies have a much thinner moat, which means competitors easily can come up and take over. An example of that is a lot of the cloud computing and cloud data storage companies and whatnot. One person does it, somebody else can do it, and if someone else does it faster or better, bam, you're out. So that's kind of on the technology side. The other side of it is stuff we already need and use and are a big part of our lives, and it's going to be kind of hard for us to stop doing it, who are adapting to the technology and starting to use it. So you can look at that. Again, I have my portfolio of companies. I actually call it my blockchain portfolio. And it's all like traditional companies in there. There's essentially, and that specific portfolio, because I have lots of portfolios, I don't think I have anything that's really even startup-y in there. But there are companies that are using and adapting to the technologies, and I want to own them. And they also pay really nice dividends, so why not? You know, I get paid while waiting, but they're going to be the one when their competitors fall to the wayside from the technology. So that's another way of looking at who's adapting to technology. You can look at who has held up fairly well. Take out tech companies here, non-tech companies who held up fairly well without government or other assistance, because that means that the demand for the service there, that doesn't mean it will be long-term, but just those are areas to look at it as well. Ultimately, it depends on the time horizon of your portfolio is the most important thing, because this is not going to happen normally I would say it's not going to happen overnight. Remember, we just got pulled 6 years in the future in 6 months. So you know that there's going to be a little bit of a what the heck just happened and a reshaking out of things as well. So during this time, diligence is really going to be key, but don't expect the last 6 months to repeat itself in the next 6 months. That might be some people say, wait a minute, the stock went up, 500% the last 6 months. Well, that's unlikely to continue because there needs to be time to absorb what's just taken place. I'm used to giving people more specific answers and ideas, but when speaking to a larger audience, it's hard to do because I don't want anyone to take anything I say as a recommendation to buy or sell anything, because I don't know their objectives and I don't know what else is going on. And so come like, oh, Kristina said this, and it's like, oh, wait, I don't know exactly what you're accomplishing. Also, many investors may have portfolios for different purposes, right? So let's say someone on this call has a Roth IRA that they don't plan to use in their lifetime. They kind of put their in it, and that's tax-free growth at distribution, and they don't really plan to use it. They might use it, but if not, it'll go to the kids or the grandkids or somebody else. That might be an area that you do the more because I got my high growth ideas, right? These are companies that probably do really, really, really well, but we don't know how long it'll take them, right? But when they do well, they'll do really well. So those types of investments you probably want to have in the Roth IRA, because if they do really well, you don't want to have to pay taxes on them, or your beneficiaries won't pay tax on them. If they do poorly, you're not using that to live off of right now. It's kind of like your long term, right? You may have an account that you kind of trade and do more speculative stuff in, and then you may have another account that's paying your bills every month. So it just depends on what your portfolio is doing to how you wanted to play this. There's no question that technology is changing our lives at a rapid pace. And what I said earlier about how we use it actually increases that, because machine learning. The machines are learning from us. And what we do, we get more of. What we don't do, we get less of. What we do, we get more. What we don't do, we get less of. And if you want to see a great example of that, look at our media. Just look at our media. They only talk about what we click on. That's it. And so when we go in and we log in and they show us stories, if we don't click on them, they don't show us those stories anymore. They track very carefully what it is that interests us, and in fact, often customize it to us. In addition, we have media that's curated, not just for us personally, how we use it, but also if you have a certain, say, political viewpoint, you can go solely to a media source that will support that. Or you can go to a generalized one, say like Google News, and it will begin to customize for what you click on. Not just what you click on news stories, but whatever all the other things that you click on. It's all curated for you. You can think the whole world is just about the stuff you're interested in, and they know that. They know that about you, unless you're super smart and you found ways to block all that stuff. But that's how things are coming, and that's how things are growing, and that's what is in those warehouses right now, which is when I talked earlier about commercial real estate, one area of commercial real estate that's doing very well and will likely do well in the future is definitely the distribution warehouses area, because All that stuff being sent to you has to be stored somewhere. So that on the technological side of it, individuals' investment strategies, whether you're doing it on your own or working with a professional, because I will say that most professionals in the industry of financial services are not particularly good at what they do necessarily. Okay. And I'm not here disparaging my competition. Any profession has people that are very, very good, very, very passionate, and you want to work with those people. And every profession out there also has people that are very, very bad and maybe not as valuable. Any profession. But I'm going to pick on my profession because that's where I'm qualified to do so. So many financial advisors or financial professionals are more salespeople than they are truly actually building or managing the portfolios or actually doing the financial planning. They're kind of an intermediary. So if you go to XYZ Bank or XYZ Investment Company, generally that's what it is. You come to them, they ask you lots of questions, they do a risk analysis on you, and then they point you in the direction of their firm's product or portfolio that is most suitable to you. So they're kind of an intermediary, which is great. It's great for people that want that person that knows them and talks to them and they can come to with anything and have a personal relationship. But that's kind of their role. They're not actually building or doing it. And that's kind of the connection. Not saying that's good, not saying that's bad. It has its purpose in place. There's other companies like Sequoia, and we're not the only one doing this, so I don't want any means to be saying it is, that customize everything. So like I said earlier, we have a menu, people pick off the menu, and that's what we do, and that's how we get paid. So people pay for what they want, and we're properly compensated for our time. Fair for everybody, right? And that there's that structure as well. Generally, if not always, these people are fiduciaries, they're properly licensed, and they have to disclose any conflicts. So you know right off the bat if they're getting paid by XYZ to sell XYZ to you, right? I'm sure that's probably the case, but it's pretty unusual. Anyway, those are the different ways that financial professionals work. The challenge is when you want guidance, where you get it from. Do you get it from an individual? If so, you want to find the right individual for you. Or do you get it from the news? Do you get it from a newsletter? And a lot of investors read newsletters, and I'll tell you there's a lot of really bad ones out there, so hopefully none of you are reading those. Newsletters, maybe there's magazines that they read, Kiplinger's, Barron's, Forbes, things like that. Or they have a strategy that they either learned themselves or were taught, read a book, and they just follow that strategy. Whatever you use, it's really good on occasion to kind of dust it off and review it and make sure it still makes sense. And I mean, anything you use, even if you hire me, you should dust me off and check me out on occasion. It's good because sometimes we get into kind of inertia with our decisions. We get into inertia with how we do things because it's comfortable and we're used to it and it's working, so why change it? Because you're individual investors, I'll talk a little bit more about your investment strategy. So the biggest mistake I've seen, and again, I'm crossing the 30 years now, so I've seen a lot of them, in investing that people make is probably about 3 areas. Biggest one is truly is neglect. On neglect. Probably none of the people on this call today, because again, you're here because you I'm sure actively watch and care for your investments. Neglect. I can't time and time someone's come to me and they have 10 401k plans at 10 different companies that they haven't worked at in 10 years, and they have no idea what's going on with them, right? And that doesn't make any sense to me from the standpoint of you're getting older. Don't you want to kind of know where all this money is and what it's doing? At least put it in one spot so you know what's going on. But that's neglect. Just no idea. I guess it's working, and I'll look at it when I have time when the kids go off to college and I'm really serious about this retirement plan. So neglect number one. Number two is, and this is more common with someone who's newer investing, which is kind of that part of being driven more by emotion, which is the fear and greed cycle, which is the, oh my gosh, this company is going up, 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 up. I got to buy it. I got to get in on it. Or the other one is, the world is ending. We have the worst president ever, or we might have the worst president ever, or this or this or this, and kind of like the national political or national social environment, and fear. Oh God, sell everything, get out before this really bad thing is about to happen. And that happened. I saw quite a bit of that after the last election. So people that really, really, really didn't like Trump were certain that the world was going to end and they should cash out their portfolios and go move to another country. And the markets weren't telling us that. The markets don't care about politics. The markets care about data, and we're telling us that. Fortunately, my clients listened to me and didn't do anything squirrely, but there are a lot of people out there that probably did, because to them the world was ending because we had the wrong person as president. It can be any event happening at the time, but it causes people to act emotionally to the greed or to the fear side. And the final one where I see it is not having, this is the one I'm going to focus on, not having a defined purpose and intention for what the money is supposed to do. Whether you do a comprehensive financial plan or you just single target. What is this portfolio supposed to do? Is it supposed to produce income for you and your family for the rest of your life? Is it supposed to grow so you can pass it on? Is it supposed to grow so you can draw from it when needed? What is its purpose in practical terms, right? When you need it, when do you need this money, and how much do you need? And what's the least risky way to get there, right? Because ultimately, all of these investments should have a purpose. Generally, the purpose is not to die with a giant pile full of money that you managed to grow over the years. Usually there's something more to it. That's kind of the reason for doing it. So having that purpose, because then it's easy to do, and you say that double check of it. Is this lined up with the purpose? Now there's subsections of that as too, like, is my investment strategy still working? So a subsection of that is, I have a strategy. This has worked really, really well. There's a really great book on it. I read it. It's worked for many, many years. It always is consistent. Works. I'm doing it. But you have to check in, because many things that have worked in the past do not necessarily work in the future. We're seeing that right now with the difference between what the growth sector is doing as opposed to the value sector. Now, yes, it's cyclical. Growth will outperform, the value will outperform, growth will outperform, value will outperform. It trades off. It always has. But what if you have companies in the value sector that will not adapt to the technological changes, and they're not going to, right? What if those companies start being absorbed more in the growth, because we're in a super cycle. A super cycle can go on for 10, 20, 30, 40 years easily. That's a long time in your lifetime, your period of time you're gaining money. So just know if a strategy that has worked in the past or has worked well for you in the past is still working. That's a subset of that. The second subset is where I'm going to have a little fun with, which is the risk. Understanding the ride before you get on the bus. And I'm just going to put a couple of slides out here, because I have a harder time with slides than I do with talking to people. And Sequoia is going to point it up. So that risk tolerance, I think we'll put a couple slides out. That risk tolerance question that you get when you open your investment account, right? Which is that, are you conservative? Are you moderate? Are you aggressive, right? And you have to answer that question. And the problem with that is it tends to be subjective. Okay, so subjective. An example, I have a client who will tell me that he's really conservative, but 100% of his portfolio is blue chip stocks. For him, that's conservative. Okay, it's conservative for him. Another client's idea of conservative is the money they have under their mattress and in gold. That's their conservative money, right? Same word, totally different viewpoints. So it's very, very, very subjective, because your idea of conservative and my idea can be very different. Early in my career, and still sometimes to this day, but especially in my career, a mistake I would make is managing a portfolio for a client. The market would drop 30%, excuse me, 30%. I'd check on my portfolio. I'd see, hey, it's down 10%. Great, we're doing a great job here. I'm happy, right? We're doing what we're supposed to do. Client calls up, let's say it's $1 million portfolio. I just lost $100,000. What the heck is going on? Full panic mode. To me, I'm saying the market's down 30, you're down 10. We're doing a great job. To the client, they just saw $100,000 evaporate. $100,000, that's real money. Difference in idea of what that means. Why? I think in percentages, clients think in money. Reasonable way of saying. So understanding the ride before you get on the bus is a really, really important thing to understand. If we can go to the next slide. I said I'm just going to use a couple of these here because it's fun. Actually, one more. So think of risk like speed limit signs. Okay, so pretty much nobody's 0 to 100, but let's use 20 to 90. right? 20 is someone in really, really, really short duration, highly rated bonds. That's the example. And money market. Okay? Really conservative, getting 1%, maybe 1.5%, but that's really hardly moving. And the 90 is I'm all in Tesla stock, Facebook or something like that. Okay, big variance in there. So imagine if you could see your personal level. So there's two pieces of this. One is your personal comfort level, most of the time how you feel about risk. Okay, that's another thing that gets people right. That changes all the time. So people's risk tolerance was probably very different in February than it was in April, right? Because in February, everything's going great. And April, the world as we know is ending, right? We're in the middle of a pandemic. We don't even know what tomorrow will bring. So risk tolerance changes with environment. Risk tolerance changes with how you feel in life at the moment because what's happening to you personally. If you or a loved one is ill, if you're worried about losing your job, right? If you're worried about your kids, there's other issues going in your life, you tend to be less risk averse. You tend to be more risk averse, less risky. If you feel more confident, you just got a big bonus, you financially feel strong, you feel like you have a solid financial plan, you tend to go up a little more because you know you can. You know that you're not eating cat food in retirement because you have a solid plan. Bam. I can take on a little more risk. I can take on a little more growth. So some of it is education and understanding, and some of it is how we feel at the moment, and a lot of it has to do with our grand thing. So imagine again speed limit signs and different people in different ways, and somebody who thinks that they're moderate, when I do the test, they come out to be really aggressive. That just happened to me yesterday with the client. That was really fun. I mean, the conversation that this person's having is they're very cautious, they're very conservative, but when we actually did the test, which takes literally 10 minutes. It's a fun test. The client actually figures it out for themselves. They don't have my opinions not involved at all, which is cool. So there's no Kristina's objectivity overriding theirs, right? They did this test, and the test is actually showing their portfolio in different, let's see if we can go ahead a couple. I want to show this real quick. And anyone listening to, I'll send you a link to this if you're interested. Okay. This I'll just give to you. Let's keep going. I just wanted to show what that looked like. Let's go one more. Okay. So actually, the first one showed. So basically, what you can see by doing this risk test is you can see, based on how you answer, what you'll accept. 95% of the time in a 6-month period, your portfolio will be in a certain range. Okay, depending how you timed out, right? How you risked out. So it's going to tell you what your portfolio would do. So let's say you're conservative. You're going to get an idea that the returns obviously be lower, but also the fluctuations will be very low. And you can look at that and say, you know what, I think I can take a little bit more than that. And then you can eke up and then you can see the trade-offs, right? On the converse side of that, you'll also see, okay, with a portfolio constructed that way, what is my expected return going to be, over time, right? So you can say, okay, well, that is not enough. Maybe I have to take more risks I'm comfortable with to actually achieve the goal. And that's what this shows. How much do I need? Tells you sometimes that you might have to either eke up your risk a little bit to get there, or you don't need to be so risky. You can be a little more conservative and still be successful and sleep better at night because you're not going to see the volatility. So knowing the ride before you get on the bus is really, really important in doing this process. What is the portfolio likely to do 95% of the time in 6 months? There is no 100% because there are still black swans and there are still outliers, but it's close enough you can see it. So your idea of what's okay is lined up with the actual holdings in the portfolio. That's one. The other thing is taking on that level of risk what I need to do. Get away that fear. Can I retire or can I stay retired successfully? Yes or no, based on this. This is based on real data. This methodology is Nobel Prize winning methodology. This is not the all algorithm. This is very solid, and I'm a geek and I checked it out. But going this process and seeing that, the other component to it is that if you have more than one, so you'll have your own personal risk comfort level. That's just how you generally feel, and that again, that switches, as I said, by life events. But then each portfolio may have it as well. So if you say have a trust account or a family account, investment account that you're living off the income currently, you may want that to be a lot less risky. You just want the income coming consistently. You don't want too much risk with that account. They want to grow because cost of living goes up, right? we're going to get inflation probably about 2 years from now. It's coming back, and you want to be prepared for that. So you still want the growth, but most important purpose of this portfolio is that income comes like clockwork, so you can pay your bills and enjoy your life. Tax efficiency matters too. Doesn't matter how much you're making if you're peeling it all off to the state and the federal government. Tax efficiency. Then maybe you have a retirement account, an IRA, and let's say you're not yet to minimum distribution phase, or this year you took the holiday that the CARES Act gave you and didn't take out your RMDs. So you have that account. That's kind of growing because you're thinking, well, I don't know how long I'm going to live, and I might need, long-term care, or I might need this or might need that, and I just don't want to run out. This one's growing. Your risk tolerance for that portfolio could be different because you see it as a little bit further down the road. And like that Roth I talked about before, that Roth IRA, that may be, I hope I don't need it. I'll give it to the kids, give it to the grandkids, give it to charity, whatever the choice is there. That could be, I'm going to put my really great ideas in that, and when they hit, and it's just going to grow. So that's an example of every portfolio you should understand, again, that ride before I get on the bus, have that risk profiling, whatever you choose to use, but also understand yourself. If you've been investing for a long time, you've probably been through enough ups and downs to get a sense of yourself. The checking of your risk is more so to see if it's still the way it used to be. And for the examples that I gave, every so often a client will come to me and all of a sudden their risk tolerance has changed significantly. In recent times, it's been a lot if people watch too much news because people who watch a lot of news tend to be a lot more scared than people that watch less news, just overall. And then their risk tolerance changed. So we talk about, should we change the portfolio? Can we back off some of the risk and still have the plan successful? That's what we want to look at. Because I want my clients to sleep at night. I want you guys to sleep at night. And if you're taking on more risk than you're comfortable with, and if the drawdowns are uncomfortable for you, or there's concerns of fear, you're not enjoying your life in the same way. So what if you can do a little less? And I'm totally not counting if you have this fun play account where you just trade in and go crazy with, it's not what you're depending on to meet your financial needs, right? But for that money, what can you take less risk and still get what you need out of the portfolio and enjoy your life? So with that, I'm going to stop. Oh, actually, I'm going to add one more thing and then stop for questions. I will offer to any of you who want to do the personal risk one, I will send you a link. I have to have your name and email. I promise you I will not call you or solicit you or bother you in any way. It's just required in order to send it the way it's set up. And you can do with it whatever you want. You'll just have that kind of risk profile. If you want me to do it on your portfolios, I will have to charge you for that. That's a lot of time and effort on my end. And out of fairness to my clients, I can't do this activity for free. And I'm not here again to solicit you. I'm just saying it's available. But get your own risk number. I'll do because I think it would be a lot of fun for you. And that, again, all I'm doing is sending you a link directly to the Riskalyze program that we use. So that's available to you. And then again, if you want to take it further, you can kind of poke around.
Is the oil and gas industry basically dead industries for now?
There's a lot of debt in that industry, a lot of debt, but it's not. In fact, I would say over the next couple of years, you're going to see a recovery in that sector. It's not going to be for a little while, though. And the reason you see a recovery in that sector is by and large is that it's working off debt right now when demand just fell off a cliff. Okay, then the sector was already kind of struggling a bit before COVID. COVID hit significantly. Our use of gas is actually only barely below where it was pre-COVID. So our use is here. There's a lot of other issues affecting it, and the biggest one is the debt. Now, I'm sorry I'm going to have to wade into politics here, but the purpose of that is answering this question. It does depend who gets elected to the White House, okay? Because there would be a very different outcome for a lot of the energy industry if Joe Biden was president and if he implemented the things he talks about on his platform. I have to say that because it doesn't mean they'll necessarily happen. Then if Donald Trump gets reelected. So that is one where I would say it will have an impact based on who the president is. But overall, it's got tremendous debt. And the demand has dropped, and it's going to take a while, but I expect oil prices will recover. But the industry is not going to be, it's probably not going to be one of the slower ones to recover. In fact, I'd say the airlines will probably beat them back, but I can't say that for sure because airlines is all about the vaccine there, the treatment.
So about debt levels, is there an easy way to check on debt levels? Like what should they look at?
Oh yeah, they have the earnings reports, so all their financials are released. Depends on what you use to get your data and information. I believe I haven't used this for years. Even on Yahoo Finance, you can pull it up. It'll have the financial information. You can definitely get it from Investor Relations if you go directly to the company's website and just ask for it. But they're public filings, so it's all there. They have to say. So when they give their earnings reports, oftentimes as a follow-up, you actually see their numbers. But any publicly traded company, it's public information. And if anything materially changes between earnings, they have to file that as well. So you can see that.
So should we, like, for example, the oil industry, should we focus on like their short-term debt, long-term debt, total debt? Is there like a area that we should focus more on and compare between companies?
It depends on the company though. So for an example, like a startup or early stage or a growth company, even a large growth company, sometimes can have a much larger debt to revenue income because every time they get money, they're just expanding and growing, expanding and growing, expanding and growing, right? That's their growth. So you can use a company as in a growth phase, they're tending to have a lot less cushion. And every time they get extra money, they use it to expand. Use it to expand. A really great example, that's Amazon. They've never made money. They may quote unquote make a lot in revenues, but they don't make money because they're just constantly throwing that out to expand because their goal is to take over the world, I assume. With companies that have been around longer, they're kind of more in the value space. You just want to look at why. Why is that debt there? Because what happens is leverage is often for acquisition purposes, whether against buying back shares or acquiring other companies. But sometimes it's just taking on too much debt and not properly using it. So you want to see, okay, they've taken on this much debt, but they've increased their revenue by this much. That makes sense. Again, because now also you can then get an extra layer of it because now we've gotten earnings reports during the COVID period because, second quarter's out now. And that one's maybe not that fair unless it continues because pretty much everybody got whacked in Q2. I mean, there's nobody that didn't have a big shock. Well, not nobody, I shouldn't say that. There's a lot of companies that didn't, but many companies got whacked. So it's kind of more how they handle it going forward. So you just want to see, is it a dangerous level of debt? And that's kind of, again, revenues. But now what you'll kind of see is if you can see their revenues from the second quarter, that's probably going to be your worst for many companies. That might be your worst worst quarter. Then again, look at third quarter when third quarter comes out in the Q4 and see, are they recovering? So second quarter is going to be bad. Third quarter, are they recovering? So high debt level, but you're not seeing a meaningful increase in earnings. Then you got a problem because they're not able to recover. If we got GDP up 25% in the third quarter and this company's not pulling up their revenues, getting back up, they're probably going to be in trouble because the amount of their revenue coming in to service debt is going to be so high that they just can't do anything. Another thing to watch for is meaningful layoffs. See huge cutbacks in companies too that are heavily indebted. And if the layoffs are that makes sense, right? All the restaurants are closed. They have to let people go, as opposed to they're cutting their workforce to try to run lean to make a profit. That's something I watch for as well. And you usually say when there'll be a major layoffs thing, you want to look at why. Is there a reason for it? Because every company that has anything bad going on for the next year is going to blame it on COVID. Literally, it'll all be COVID. It'll be COVID. Everything will be COVID. Just like in weather events, it's always the hurricane or the earthquake. It's whatever it is, it's going to be blamed on COVID. You want to look and see if it's a COVID thing, it should be recovering meaningfully by the third quarter, with the exception of travel and leisure, sporting events, things like obviously things are still shut down. Hope that's simplistic, but all the data is available. Either on the investor relations section of their website or on the earnings reports as they're filed. And again, I believe it used to be readily available on Yahoo Finance, which is accessible to everyone. And, but I haven't checked recently, so I'm not sure.
Got it. So what are your thoughts on market projections, the average market projections between now and November versus kind of post-November?
I don't actually know what the average are. We're pretty close to where I expect the market to finish the year. Again, I have not modeled out anything relating to a vaccine or what I want to call a super COVID fix-it event where COVID's not as much of an issue because that's a wild card and there's no way you can really model that one in. Highest probability at this point is that we have a vaccine the end of this year, next year, but we all can understand it'll take some time to get enough of the population vaccinated that it's no longer a threat or an issue. And that's the highest probability. Obviously, we know that the vaccine could be sooner. Obviously, we know it could also be a failure, but the high probability at this point, based on consensus on the vaccine doctors and whatnot, is we're gonna go with that. So the market is fairly close to where we project it to be at the end. It was really funny when I was giving these numbers back in May and June. People thought I was insane, and now we're kind of there. But remember, a lot of that was drawn or was pushed forward by about 5 companies in the S&P 500, and the other 495 were sort of languishing. And this is very simplistic. It wasn't exactly like that, but pretty close. And now what we're starting to see is wave 2, not to be confused with COVID's wave 2. Wave 2, where we're starting to see some of the companies that hadn't been the leaders now coming up. So it's a more breadth in companies recovering. Now we are in a corrective phase right now, which is very, very healthy. And data does not support it being any more than a corrective phase, which is good because we need to let some air out of the tires. There's some of these companies got stupidly overvalued, and we're to let some air out of the tires. It's good. What I watch closely is what are the rest of the companies doing, or the rest of the companies doing. I expect a boost in the markets come the end of October when GDP data hits, because those will be really meaningful numbers. Now, understand that's like days before the election, so it's going to be a really one party's not going to want to see that number, and one party is really going to want to see that number, but it's going to be a big number up on the upside. Again, at this point, we're 3 weeks from the end of the quarter. It's unlikely it's going to be a lot different than projections. So that's going to be probably, I don't know what will happen between now and then, but on the political end, but that's probably going to be something that's going to get a lot of, a lot of attention. I mean, the markets are, like I said, getting there. But again, COVID's our big question. And not just COVID, but how states manage their shutdowns and whatnot, and how people start moving about. What happens as we get into the holidays? And there's a lot of people that were fine with the shelter in place thing for a month or 2 months or 3 months. And I can assure you by what I'm seeing, and again, I'm one person, so it's not statistically valid data, a lot more people are kind of, I want to use the word over it. They are getting together with family. They are going to see grandma. They are getting their kids with their kids' friends. I think there's only so long that people, for the most part, the population was going to stay with the shelter in place. And I'm not saying everybody's going crazy and, taking off their masks and doing giant parties or anything, but there's definitely, people are getting more comfortable going outside of what they would a few months ago. So then we come into the holiday season. I'm not as concerned about a big flu season being a danger, a big COVID resurgence. If anything, maybe if we're all socially distancing and wearing masks, there's less flu and less illness. I don't know. I'm not a doctor or a virologist, so I'm not going to get into that debate. But I say as we get into the holiday season, how is the holiday season, which is a big spending season in this country, Black Friday, holiday shopping, how is that impacted by all of this? That's sort of a little bit of a wild card. Do people go even crazier buying stuff for people because they can't get around them? Or do people just say, you know what, we're skipping Christmas this year. Let's just do it when this is over. And that'll be very interesting because that's a lot of the economy as well, especially on the retail side of it. So those are some factors to consider in there. Again, the election, the markets will likely be volatile around the fact that there's a high probability of the election being contested. But in the end, it's short term. It's not really a long-term economic thing. The economy won't shut down over it. People will still do what they do. It'll just be a lot of noise around it and the process. And of course, the losing party and the winning party and how that plays out. I think that's probably one of the bigger negatives to the economy, to the markets in between now and the end of the year. But more of it is real. That's a short-term thing, and it's just mostly political theater and news noise than it is real. The real is what the people do. Do people continue to loosen up, or do people tighten up again because there's a resurgence in the disease, or just for whatever reason just don't feel like the holidays should happen this year?
So if you're retirement, can there be an advantage to mixing your withdrawals from an IRA versus a Roth?
Yeah, well, if you are over 72, you have to take RMDs, required minimum distributions, from your IRA or your 401k. Okay, your Roth, you don't have to do that for. That's a difference. This year with the CARES Act, you actually don't have to take your RMD. You get an RMD holiday. So if you don't need the money, the question is this year, should you take the holiday, right? Or if you don't need the money, should you take it? There's pros and cons to that. Every year you don't, I mean, just all things being equal, let's assume your portfolio doesn't grow next year. If you don't take it this year, you'll have to take more out next year because the value will be higher. I'm just assuming no growth in the portfolio, right? Say you have a $500,000 IRA, you don't take the money out, it's priced at the end of the year, and then that's how much you have to take next year. So you have to take a little bit more out next year if you don't take it out this year, unless the value declines. So I said to my clients, basically, if you don't need it, don't take it. We'll figure it out next year, right? For the most part. If you need it, take it because you need it anyway. It's pretty much been that. But there have been exceptions where I've said, you know what, take it anyway because it's just going to keep hitting you in taxes and hitting you in taxes as well. So it's very much individualized whether you should take it or not based on your plan. From a tax efficiency, what else is going on in your life? A key thing to me in doing planning is that investment returns are not guaranteed, but tax planning is. And that's, I can actually say to a client, if you do it this way, you're going to pay this much less in taxes. That's a certainty. So I tend to look at that more as if you need $100,000 a year to live off of, what's the most tax efficient way we can get that? From which account? The people who have one account, like all their money's in an IRA or 401k, they have one option, and that's all tax at ordinary income. That's it. So they have high taxes and nothing you can do because they need $100,000. They have to pull it all out of the IRA, which means after the government's done with them, they need to pull out like $130,000 and pay the government, which means they have less money to live off of. But if that same person has a Roth IRA and they have their IRA and then they have an investment account, maybe a bank account and maybe some Social Security, and if they're super lucky, they even have a pension and stuff like that, then we can get the $100,000 from lots of little buckets, reduce the taxable income, which means more money stays in your pocket. So it so depends on what else is going on as to where's the best place to get it. But ultimately, the game is to pay as little in taxes as legally possible. Generally, again, individualized as well. Sometimes people make decisions that have nothing to do with financial or tax efficiency, like helping out your kids and stuff like that. If you're curious about that risk, to know your individual risk and go through it, I will send you a link to the test that you can do to understand it.
Kristina, thanks very much. I'm sure our members enjoyed, and there were some very interesting comments and examples given, so we appreciate that.
And just what I say for investors is that despite all of the news and things coming out there, there's always opportunity and there's always risk. And being aware of that is key to being successful over time. But most importantly is knowing yourself, knowing your plan, knowing your goals, knowing the ride, again, before you get on the bus, understanding these things. That's critical to success because you don't only want to be successful, you also want to enjoy the process of getting there. That's the highest thing that I can say about everything that I said today.